Hello there and welcome to History for Lunatics. I'm so glad you're here tonight. Settle in wherever you are. Maybe you are listening from bed, maybe from a quiet room with only one lamp on, maybe from a desk where the day has gone on a little longer than it should have. Tonight we are going to Wall Street, but not the Wall Street of champagne, closing bells, polished shoes, and men smiling for magazine covers beside piles of invisible money. We're going to the Wall Street that wakes up with a bad feeling in its stomach. The Wall Street of ringing phones, crowded trading floors, paper tickets, computer screens, coffee gone cold, and people pretending for as long as they can that what is happening is still normal. We're going to one Monday in October, the kind of Monday that begins like a workday and ends like a historical warning. The date is October 19th, 1987. And by the time the closing bell sounds, the Dow Jones Industrial Average will have fallen 508 points. That number may sound small now in a world where the market is much larger, where financial news scrolls across phones every minute, where people talk about points and percentages almost casually. But in 1987, 508 points meant something enormous. It meant 22.6% of the Dow's value gone in one day. Not over a year, not over a month, not even over a terrible week. One day. Imagine waking up, going to work, looking at the market as something solid, something powerful, something that had been rising for years, and then watching nearly a quarter of it disappear before dinner. That is where we are going tonight. Not into a battlefield, not into a burning city, not into a courtroom where one famous decision changes everything. We're going into a place where the disaster happened through numbers, through orders, through fear moving faster than hands could write and voices could shout. And because this is Wall Street, because this is a world that often hides human panic behind clean graphs and serious language, we're going to slow it down. We're going to stand inside that morning and look at what people saw, what they heard, what they believed, and what they did not yet understand. Before we go any further, I want to ask you something simple. What time is it where you are right now? Is it late enough that the streets outside have gone quiet? Are you listening from a city, a small town, a bedroom, a couch, a place far away from New York but somehow still connected to the strange machinery of money? If you feel like sharing where you're listening from, I always love reading those comments. There is something oddly comforting about knowing that people are hearing the same story from different corners of the world. And if this kind of storytelling speaks to you, if you like history told slowly, with ordinary people placed back inside the moments they had to live through, then give the video a like and subscribe when it feels right. You do not have to do it now. Wait until something in the story makes you think, or makes you look differently at the world outside your window. Now let's go back to New York, not the New York of today, but the New York of the late 1980s, when the phones had cords, the computers were still strange enough to feel powerful and mysterious, and the stock market had spent years convincing a great many people that the good times had learned how to keep going. The morning of October 19th, 1987 did not arrive out of nowhere. That is important to understand. Disasters almost never do. They may feel sudden to the people inside them, but when historians look backward, they usually see warning signs scattered around like objects left on a staircase in the dark. The market had been rising for years. America had moved out of the hard early 1980s, out of recession, out of the long shadow of inflation, and into a period where confidence began to sound like common sense. The Dow had surged. Corporate takeovers filled the business pages. New fortunes appeared quickly. Young traders with suspenders, sharp elbows, and no memory of 1929 treated speed as a kind of intelligence. There was a feeling in the air, not everywhere in America, not for every family or every worker, but certainly in the financial world, that money had become more clever than trouble. Wall Street had always contained pride, but the 1980s gave that pride a new language. Leverage, arbitrage, takeovers, portfolio insurance, program trading. These were not kitchen table words. They were words spoken by people who believed they understood risk, because they had found new ways to measure it. And that belief, as history keeps reminding us, can be very dangerous. By the time the sun rose over New York on that Monday, the market had already been shaken. The previous week had been ugly. On Wednesday, stocks had fallen. On Thursday, they had fallen again. On Friday, the selling had become worse, and the Dow had dropped more than 100 points, which at the time was enough to make people stop mid-sentence. Weekend newspapers carried anxiety into homes. Television commentators tried to explain what had happened without admitting that they did not know what would happen next. Traders went home on Friday with the market wounded, then spent Saturday and Sunday doing something people in finance rarely admit they are doing. They worried. They called one another. They read. They listened for rumours. They watched foreign markets. They told themselves that Monday might bring a rebound because markets often bounce after a hard fall, and because hope, especially professional hope, can sound very reasonable when said in the right tone. But by Monday morning, before the New York Stock Exchange opened, the trouble had already travelled around the world. Markets in Asia and Europe had been hit. Selling was not waiting politely for Wall Street. It was moving across time zones, country by country, exchange by exchange, as if fear had found an international schedule and meant to keep every appointment. This is one of the things that made 1987 feel different from older panics. In 1929, the crash had its own speed, terrible enough in its time, but still bound to a slower communications world. By 1987, the financial system was connected by screens, cables, wires, futures markets, index funds, and institutional investors who could move enormous sums with an efficiency that earlier generations would have found almost unbelievable. The world had not yet become the instant digital marketplace we know now, but it was already fast enough to frighten itself, and on that morning speed mattered. It mattered because there were more orders than calm people. It mattered because the futures markets opened before many individual stocks could trade properly. It mattered because modern finance had built systems that worked beautifully when the market moved within expected limits, and no one was quite sure what would happen when too many people tried to get through the same narrow exit at once. Picture the floor of the New York Stock Exchange that morning. Not the quiet electronic market most people imagine today, where buying and selling seem to happen somewhere invisible, inside servers and code. In 1987, the floor was still a physical place filled with bodies. Traders stood in crowds, clerks carried paper, phones rang constantly. Specialists managed trading in particular stocks, trying to match buyers and sellers in a way that kept the market orderly. Jackets identified roles. Faces were close together. People shouted because shouting was still part of the system. It looked chaotic even on a normal day, but there was order inside that chaos, a rhythm known to the people who worked there. They understood the noise. They understood the hand signals. They understood the pressure. What they were about to face was different. Before the opening bell, sell orders were already piled up like stormwater behind a weak door. Many stocks could not open on time because there were too many sellers and not enough buyers at prices that made sense. That delay itself became frightening. A stock that did not open was not calm. It was suspended in uncertainty. People knew there was selling pressure inside it, waiting to be revealed. And while the floor struggled to open individual stocks, the futures market was already moving, showing prices lower, pulling expectations down, giving everyone a number to fear before the cash market had fully found its footing. This is the kind of detail that sounds technical until you imagine being there. You're a trader. You're trying to do your job. Your phone is ringing. A client wants out. Another client wants a price. A manager wants to know why an order has not been filled. The screen is red. The stock you need to trade is delayed. The futures market says everything is worse than the official prices show. Around you, people are shouting names and numbers, but the numbers are changing too fast to feel like information. They begin to feel like weather, and the weather is turning. The strange thing about a market crash is that it is both deeply human and strangely impersonal. No single trader can be blamed for the whole thing. No one person stands at the centre pulling a lever-marked disaster. Instead, thousands of decisions, each defensible in isolation, combine into something no one intended but everyone has to survive. A pension fund reduces exposure. A portfolio insurer sells futures because its model tells it to protect against further losses. A mutual fund faces redemptions. A trader sells because he believes someone else will sell first. A buyer steps back because why catch a falling knife if waiting 5 minutes gives you a lower price? A specialist delays opening a stock because the order imbalance is too large. Each action has a reason. Each person can explain himself. And still, when all of it happens at the same time, the market becomes a room where everyone rushes toward the door and then discovers the door is smaller than they thought. That morning, people were not only reacting to prices, they were reacting to the idea that other people were reacting. This is what panic does. It turns imagination into evidence. If everyone else is selling, maybe they know something. If the price is falling, maybe it should be falling. If the market cannot hold at one level, perhaps it will not hold at the next one either. In ordinary life, we know this feeling in smaller ways. You see a line forming and wonder what people are waiting for. You see a crowd move quickly and feel your own body prepare to move before your mind knows why. Financial panic is that same instinct dressed in suits, numbers, and institutional language. It is fear made respectable by a ticker tape. By mid-morning, what had started as a frightening opening had become something heavier. The Dow was falling, but the number alone does not capture what that meant inside the building. Traders were watching familiar names drop in ways that felt unreal. Blue-chip companies, the kind of companies people considered solid enough to form the backbone of retirement accounts and pension funds, were being sold aggressively. It was not only speculative corners of the market, it was not only weak companies or strange companies or fashionable little stocks that had flown too high. The selling reached into the centre. That is when fear changes character. A correction can be explained, a rough week can be endured. But when the strongest names begin to fall with everything else, people stop asking which stocks are in trouble and start asking whether the market itself is in trouble. Outside the exchange, New York continued with its Monday. Taxis moved through traffic. Office workers bought coffee. Elevators opened and closed in towers where people talked about meetings, deadlines, lunch plans, and the usual complaints of a workday. That contrast matters. History often looks dramatic from a distance because we know what the day became. But inside the day, life remains ordinary for longer than we expect. Someone was annoyed at a delayed subway. Someone was buying a newspaper without yet understanding that the next morning's newspaper would belong to history. Someone in an office uptown was calling a broker and being placed on hold. Someone in a house far from New York had savings in a mutual fund, and no way of knowing, hour by hour, what was happening to it. In 1987, most ordinary Americans did not watch their portfolios on a phone. They did not refresh a brokerage app. They waited for the evening news, for the newspaper, for a call, for a statement that would arrive later. Panic moved quickly inside Wall Street, but for much of the country, the fear arrived in stages, first as rumour, then as a headline, then as a number explained by a serious-looking anchor on television. This delay created its own kind of helplessness. People knew the market mattered, even if they did not fully understand how. They knew pension funds were tied to it. They knew retirement accounts were becoming more common. They knew companies watched it. They knew banks cared about it. But the machinery was distant. A person could be affected by Wall Street without ever having seen the trading floor, and that is one reason crashes feel so unsettling. They reveal that the ordinary world is connected to a system most people do not control and cannot see clearly. For the men and women inside financial firms that morning, there was no distance. The trouble was immediate. At Merrill Lynch, Salomon Brothers, Morgan Stanley, Goldman Sachs, and dozens of smaller firms, people watched screens and tried to sound calm on the phone. Calm is part of the job in finance. The voice matters. You do not tell a client that you're scared. even if your stomach has gone cold. You do not say that the market looks disorderly, even if everyone can see that it does. You say things like volatility, pressure, imbalance, heavy selling, institutional flows. These words are useful, but they also protect the speaker. They give fear a suit jacket. They allow the professional to keep talking when the private mind is thinking something much simpler. This is bad. This is very bad. One of the most important forces behind the day was something called portfolio insurance, and we should pause with it because it tells us so much about the mood of the years before the crash. Portfolio insurance was not insurance in the way most people use that word. There was no friendly agent, no policy, no company promising to write a check after a loss. It was a trading strategy designed to protect large investors from severe market declines by selling stock index futures as the market fell. In theory, it allowed institutions to stay invested while limiting losses. It was marketed as a modern solution to an old problem. You could enjoy the rise and protect yourself from the fall. That idea was extremely attractive in a bull market. It made risk feel managed. It made danger feel engineered into submission. But on a day when the market was already falling sharply, many of these strategies pointed in the same direction at the same time: sell. And when selling caused more declines, the models could call for more selling. This did not create fear from nothing, but it amplified fear that already existed. It turned a human instinct into a mechanical instruction. That is one of the unsettling lessons of Black Monday. The machines did not need to be evil. The models did not need to be foolish in ordinary conditions. The danger came from the fact that too many people trusted similar protection at the same moment. A lifeboat is useful. 1,000 people running toward one lifeboat is a different problem. The people who built and used these systems were not cartoon villains. Many were intelligent, serious, mathematically trained professionals trying to solve real investment problems. That is what makes the story more interesting and more disturbing. History is rarely kind enough to give us only fools making obvious mistakes. More often, it gives us smart people, making decisions that work until the day they do not. By late morning, the market's decline was no longer a matter for specialists and traders only. It had become national news in motion. Financial television was not yet the constant force it would become later, but newsrooms knew something extraordinary was happening. Reporters called sources, editors prepared updates, radio bulletins carried the anxiety outward. The language of comparison began immediately because whenever markets fall hard, people reach for 1929. That old year waits behind every American financial panic like a ghost standing just outside the frame. Was this another 1929? Was this the beginning of another depression? Was the prosperity of the 1980s a shell? Those questions may sound exaggerated now because we know what came after. We know the economy did not collapse into another Great Depression. We know the market eventually recovered. But the people living through that Monday did not know any of that. They only had the day in front of them, and the day was getting worse. This is something worth remembering whenever we look back at panic with the smugness of hindsight. People inside history do not know which disaster will be contained and which disaster will become the start of something larger. They do not know whether the floor will hold. They do not know whether tomorrow will bring relief or ruin. They have to act while the ending is still hidden. That is the human pressure of October 19th, 1987. Not just that the market fell, but that while it was falling, no one could honestly say where the bottom was. A trader could look at a screen and see a price lower than it had been 5 minutes before. He could answer a phone and hear a client asking whether to sell now before it got worse. He could look across the floor and see men who had built their identity on confidence suddenly wearing expressions they would later deny having. He could tell himself that there had been crashes before and recoveries after, but he still had to decide what to do with the next order. History, in that moment, was not a lesson. It was a ringing phone. Around noon, the mood did not truly improve. There were moments when selling seemed to pause, moments when people looked for a bottom, moments when a bid appeared, and someone hoped that maybe the worst had passed. Markets often move in waves, and hope can return in small, dangerous flashes. But each attempt at stability seemed fragile. The pressure kept building. The systems were strained. The volume was enormous. Orders lagged. Information moved imperfectly. Prices on one market did not always line up neatly with prices on another. The difference between what something was worth, what someone would pay, and what a screen showed became harder to trust. Trust is not a decoration in markets. It is the flaw. When buyers and sellers trust that prices are real, that trades will settle, that systems will function, markets can absorb bad news. But when trust itself weakens, every number begins to wobble. On Black Monday, people were not only asking how low stocks would go, they were asking whether the mechanisms of the market could handle what was happening. That question is much more frightening than a bad price. A bad price can recover. A broken mechanism suggests something deeper. It suggests that the machine built to process fear has become part of the fear. For ordinary workers on Wall Street, the day was also physical. We sometimes talk about markets as if they exist in pure abstraction, but the people inside them have bodies. Their throats get dry. Their hands shake. Their backs hurt from standing. Their ears ring from hours of shouting and phones. Their shirts stick to them. They forget to eat. They drink coffee because there is no time for anything else and then realise the coffee makes the nerves worse. A clerk carrying order slips across the floor was not thinking in grand historical terms. He was trying not to make a mistake. A young trader who had never seen a real crash was trying to look like someone who had. An older trader who had heard stories from 1929, from 1962, from 1974, from every earlier break in the market, was discovering that memory does not make panic comfortable. It only gives it a family resemblance. The floor was filled with men and women doing the small tasks that keep a market alive, and the small tasks were becoming harder. This is why I want to resist the easy version of the story, the one where Black Monday is only about greed or computers or reckless Wall Street arrogance. Those things belong in the story, certainly. The 1980s financial culture had plenty of arrogance. The faith in financial engineering had grown too large. The market had risen too far too fast. But when the day arrived, it was lived minute by people who were not symbols. They were workers inside a system, some powerful, some not, some wealthy, some simply employed by the wealthy, all caught inside the same downward movement. A crash is not only a judgment on an era. It is also a workplace event, a human event, a day when ordinary routines fail in public. As the afternoon approached, the question was no longer whether Monday would be bad. That had been answered. The question was how bad a single day could become, and the answer was still forming. The market had not yet reached its most terrifying stretch. The final hour had not yet arrived. The closing bell was still far enough away to feel unreachable. Somewhere in the machinery of the financial world, sell orders were still coming. Somewhere a model was still telling a manager to reduce exposure. Somewhere a client was still calling with a voice that tried to sound calm and failed. Somewhere a broker was still saying, "I'm trying," because there was nothing better to say. And beyond the glass, beyond the trading floor, beyond Lower Manhattan, America was moving through an ordinary Monday that was about to become the day people would mention for decades, whenever they wanted to describe how quickly confidence can fall apart. The morning had opened with nerves, with pressure, with a sense that the previous week's trouble might not be finished. By midday, the nervousness had become something heavier, something that could no longer be explained away as a rough start or a temporary imbalance. The great bull market of the 1980s, the market that had made so many people feel clever and safe, was now showing its other face. To understand why that face shocked people so deeply, we have to step back from the trading floor for a while and look at the years that came before it. The long rise that made Wall Street believe it had learned to manage danger, and the confidence that made the fall feel almost impossible until it was already happening. To understand why October 19th, 1987, felt so shocking, you have to understand the years that came before it, because no one falls from a low place and calls it a catastrophe. The fear of that Monday came from the height. It came from the fact that Wall Street had spent 5 years climbing, 5 years recovering from the gloom of the early 1980s, 5 years telling itself that something new had begun. By the time traders walked into their offices in the autumn of 1987, many of them had grown used to a market that moved in the right direction, often enough to make caution feel old-fashioned. That is always a dangerous moment in financial history, not when people are afraid. Fear can make people careful. The truly dangerous moment often comes when enough people have been rewarded for believing that trouble belongs to the past. Let us go back to 1982 for a moment, because that is where the long rise really begins. The United States at the start of the 1980s did not feel like a country on the edge of a glorious bull market. It felt tired. Inflation had eaten into wages and savings through the 1970s. Interest rates had been painfully high. Mortgages were expensive. Factories were closing in some towns. The word recession was not an abstract term you heard on television and forgot by dinner. It was a presence in people's lives. It was visible in layoffs, in empty storefronts, in families postponing purchases, in young couples realizing that buying a home had become almost impossible at the rates banks were asking. People who lived through that period remembered the strange combination of high prices, high borrowing costs, and low confidence. It was not the sort of soil where you would expect a Wall Street boom to grow, and yet history often begins its turn before ordinary people feel it. In August of 1982, the Dow Jones Industrial Average was around 777 points. That number is important not because people at the time saw it as the beginning of something grand, but because 5 years later it would look like the floor of a staircase no one realized they had started climbing. Inflation began to come under control. Interest rates, after reaching punishing levels, started moving lower. The Federal Reserve, under Paul Volcker, had forced the economy through a harsh medicine to break inflation's grip. It had hurt. It had angered people. It had contributed to recession and hardship. But as inflation cooled, a certain pressure lifted from the financial system. Money did not suddenly become easy for everyone, but the direction had changed, and direction matters deeply in markets. A bad number improving can feel better than a decent number getting worse. Wall Street is often less interested in how things are than in where people believe they're going. By 1983 and 1984, the mood was noticeably different. The Reagan administration spoke the language of tax cuts, deregulation, business confidence, and American renewal. Whether a person loved Reagan or disliked him, the tone of the era mattered. The government was sending a signal that business was not the villain of the story. Wall Street heard that signal clearly, corporate leaders heard it, investors heard it. The country was still complicated, still unequal, still full of families who were not sharing equally in the recovery, but the financial markets began to act as if a door had opened. Stock prices rose. The newspapers started carrying stories about deals, takeovers, new wealth, and new financial personalities. A person could feel, even from far away, that the language of money was becoming louder in American culture. This is the part I want you to sit with for a moment, because it is easy to talk about a bull market as if it were just a line on a chart. A bull market is also a mood. It changes how people speak. It changes what they consider reasonable. It changes the way a young broker answers the phone, the way a company executive thinks about debt, the way a retiree looks at a brokerage statement, the way a newspaper editor decides which business story belongs on the front page. During a rising market, confidence does not arrive all at once. It accumulates. 1 good month becomes evidence. 1 good year becomes a pattern. 3 good years become a belief. 5 good years become something close to common sense. By the middle of the 1980s, a great many people had begun to absorb the idea that stocks were not merely investments. They were proof that America had found its rhythm again. On Wall Street, that confidence had a physical life. It lived in offices where phones rang all day, and men in shirt sleeves leaned back in chairs after a successful trade. It lived in lunchrooms where deals were discussed as if they were sporting events. It lived in taxis carrying young bankers home after midnight, exhausted but pleased with themselves, believing that exhaustion was simply the price of joining the winning side of American life. It lived in expensive suits, in crowded restaurants, in the strange new respect given to people who could talk fluently about mergers, bond yields, and takeover targets. The financial world had always rewarded ambition, but the 1980s gave that ambition a kind of glamour. Wall Street was not just where money was managed. It was where a certain version of the future seemed to be manufactured. The Dow kept climbing. Not smoothly every day, not without interruptions, but with enough force that the interruptions were often treated as temporary. From the summer of 1982 to the summer of 1987, the Dow rose from below 800 to more than 2,700. That was not a gentle improvement. That was a transformation. Think about what that meant psychologically. A person who had bought into the market in the early 1980s had seen numbers more than triple. Pension funds had grown. Mutual funds had attracted attention. Brokerage firms had a powerful story to tell. Even people who did not understand the market in detail could understand a statement that was larger than the last one. The evidence arrived in envelopes, in newspapers, in conversations at work. It did not feel theoretical. It felt like proof. And proof, in markets, is dangerous when it begins to replace judgment. The longer prices rise, the easier it becomes to believe that rising is what prices naturally do. This is not because investors are foolish. Many are not. It is because human beings are pattern-seeking creatures. We take yesterday, place it beside today, and quietly begin to sketch tomorrow in the same direction. In ordinary life, this instinct helps us. If the road has been safe for miles, we expect the next mile to be safe. If a neighbour has always been kind, we expect kindness again. If the market has rewarded optimism year after year, optimism begins to feel less like a temperament and more like intelligence. By 1987, a whole generation of younger traders had never experienced anything like 1929, and many had not worked through the brutal bear markets of earlier decades in any meaningful professional way. They knew crashes as history. They knew panic as something older men talked about. They knew downturns, certainly, but not a day that could take the breath out of the whole financial world. The boom was not only about stock prices, it was about corporate America changing shape. The 1980s became the age of takeovers, leveraged buyouts, corporate raiders, and companies forced to defend themselves from being swallowed. Names like Carl Icahn, T. Boone Pickens, Henry Kravis, and Michael Milken moved through the business pages with the weight of characters in a new American drama. Some were admired as bold reformers who forced lazy management to answer to shareholders. Others were feared as ruthless deal-makers who saw companies less as communities of workers and more as collections of assets waiting to be rearranged. However people judged them, they changed the atmosphere. A company's stock could leap because someone might be preparing a bid. Debt could be used as a weapon. Junk bonds, high-yield bonds issued by companies with lower credit ratings, became fuel for deals that would have seemed impossible in an earlier moment. The market was no longer only a place where people invested in the future earnings of companies. It was also a place where companies themselves could become targets, prizes, pieces in a larger game. For the ordinary worker inside those companies, this was not always exciting. A stock price rising because of a takeover rumour could mean applause on Wall Street and anxiety in a factory town. It could mean layoffs, restructuring, the sale of divisions, the closing of offices, the end of a way of life that had seemed stable. This is one of the uncomfortable truths of the 1980s boom. The same financial movement that made some investors rich made many workers feel less secure. Wall Street celebrated efficiency. People in towns built around one employer heard that word and wondered whether efficiency meant their job. The market could look like national strength from a trading desk and still feel like a threat at a kitchen table. Both things were true at the same time. Inside the financial world, though, The takeover culture added fuel to the rise. Stocks were not merely valued on what a company earned, they were also valued on what someone might pay to acquire it. Rumour became a kind of currency. A whisper about a possible bid could lift a stock before any official announcement existed. Traders learned to watch for signs, heavy volume, unusual options activity. A company with undervalued assets, a management team considered vulnerable. This created an atmosphere where expectation itself had value. People were not only buying businesses, they were buying the possibility of drama. And when enough people buy possibility, prices can move far beyond what caution would suggest. There was also a wider social change happening. More Americans were being drawn, directly or indirectly, into the market. Retirement savings were shifting in ways that would matter enormously over time. The old world of guaranteed pensions was beginning to give ground to accounts where workers bore more responsibility and more risk. The 401k, created by changes in tax law at the end of the 1970s and spreading through the 1980s, was still new compared with what it would later become, but the direction was clear. Ordinary Americans were being connected to Wall Street through retirement accounts, mutual funds, pension funds, and insurance products. Many of them were not day traders. They were teachers, engineers, office workers, utility employees, airline workers, people who did not spend their mornings studying charts. But their futures were increasingly tied to a market whose movements they did not control. This is where the story becomes more intimate. Imagine a middle-aged couple in 1986 opening an account statement at the kitchen table. They are not rich. They have a mortgage, maybe one child in college or approaching college age, maybe an aging parent who may need help soon. They look at the numbers and see growth, not a fortune, but enough to make the future seem less frightening. They hear on television that the market is strong. They hear from a friend that mutual funds are doing well. They may not understand leveraged buyouts or index arbitrage, but they understand that their savings are larger than before. That feeling matters. It gives people permission to relax a little. It allows them to imagine retirement not as luxury but as possibility. The boom did not make everyone wealthy. Far from it. But it gave enough people enough visible progress to create a climate of trust, and Wall Street fed on trust. Brokerage firms expanded, financial advertising became more confident, business magazines gave heroic treatment to executives and investors. The language of winning entered the culture. The film Wall Street would be released in December 1987 after the crash, but the world it depicted had been forming for years before audiences heard Gordon Gekko say that greed was good. That line became famous because it captured something already in the air. It did not invent the mood. It named it. In the years before Black Monday, money had become entertainment, status, argument, identity. The market was not hidden in the financial pages anymore. It was moving into the centre of American imagination. Now, it would be unfair to say that everyone was blind. Some people worried. Some analysts warned that prices had risen too fast. Some noticed that price-to-earnings ratios looked stretched. Some watched interest rates and felt uneasy. Some understood that the dollar, trade deficits, and international currency agreements could create pressure. The United States had been running large trade deficits, and by 1987 concerns about the dollar and inflation were becoming harder to ignore. When interest rates rise, stocks often become less attractive because bonds offer better returns and corporate borrowing costs increase. This is not a dramatic idea, but it is a powerful one. A market can tolerate many problems while confidence is high. But if confidence begins to crack, the same facts people dismissed in July can sound alarming by October. This is one of the strange features of financial history. Warning signs often exist long before a crash, but they do not become warnings to everyone at the same time. A rising market has a way of explaining away bad news. Trade deficit, manageable, interest rates, temporary, high valuations, justified by growth, heavy takeover debt, a sign of financial creativity, portfolio insurance, a clever protection. program trading, the future arriving. Each concern can be answered. Each answer may even sound reasonable by itself. But concerns do not always matter one at a time. Sometimes they gather quietly, like weight on a shelf. Nothing breaks until it does. The new financial tools of the 1980s made people feel especially safe. Portfolio insurance in particular offered a comforting promise to large institutions. You could remain in the market and still protect yourself against a major decline by selling futures as prices fell. It sounded disciplined. It sounded scientific. It sounded like a way to remove the old human weakness from investing. No panic, no guessing. Just a model that told you what to do. In a calm market, that confidence was seductive. The very phrase portfolio insurance softened the risk. Insurance is a word people associate with protection. It suggests someone has already thought about the disaster and prepared for it. It makes the future feel less wild. But this kind of insurance depended on markets functioning well enough to absorb the trades. It depended on the ability to sell when selling was needed. It depended on the assumption that not too many people would try the same protective move at the same time. That assumption would become one of the great problems of Black Monday, but in the long boom, it did not feel like a problem. It felt like progress. Computers were becoming part of Wall Street's nervous system. They were not yet the invisible masters of trading that they would become in later decades, but they were already changing the speed and scale of decision-making. Program trading allowed baskets of stocks and futures to be bought or sold according to formulas. Index arbitrage connected stock prices and futures prices in ways that created opportunities for quick trades. Large institutions could move with a speed that old floor traders found impressive and sometimes unsettling. The market was still full of people shouting, writing, carrying, calling, and sweating, but behind them stood systems that could turn a market move into a wave of orders faster than human judgment could comfortably absorb. There is a temptation to imagine computers as cold and humans as emotional, but the truth is more complicated. The computers did not remove emotion. They gave emotion a faster delivery system. A human fear could become a programmed instruction. A model built during a rising market could become a command during a falling one. A strategy designed to protect one portfolio could, when used by many investors, help pressure the whole market. None of this was obvious enough in advance to stop the boom. The market was rising, clients were pleased. Firms were making money, protection had been purchased, systems were working. When a machine works for you day after day, it is hard to imagine the first day it works against you. The long boom also changed the people who worked inside it. A young person entering Wall Street in the early 1980s could see a career ladder that seemed almost vertical. The hours were brutal, the culture aggressive, the pressure constant, but the rewards were visible. Bonuses could transform lives. A person from a modest background could suddenly rent a better apartment, buy expensive clothes, eat in restaurants where older relatives would have felt out of place, and send money home while pretending not to be impressed by his own success. There were secretaries, clerks, assistants, messengers, analysts, salespeople, traders, and bankers all moving through this world at different levels of power. Not everyone became rich. Many simply worked hard around those who did, but everyone could feel the expansion. More business meant more calls, more paperwork, more hiring, more noise, more urgency, more belief that tomorrow would be larger than today. In that atmosphere, caution could start to look like cowardice. A broker who warned clients too often might lose them to another broker with a more exciting story. A fund manager holding too much cash while the market rose could look foolish. A corporate executive refusing to consider debt-financed expansion could seem timid. A trader who stepped back from a rally might watch someone else make money and feel the sting of it. Markets do not only reward greed, they punish hesitation during booms. That is why bubbles and overextended markets are so difficult to resist from the inside. It is not enough to be right eventually. You have to survive being wrong-looking for a long time. Many people cannot. Many institutions cannot. They join because the cost of standing aside becomes too visible. And so, by the summer of 1987, Wall Street had become a place filled with confidence that had been trained by repetition. The Dow crossed 2,000 in January. That was celebrated as a milestone, but the year did not stop there. It pushed higher through the spring and summer, reaching its peak in late August at 2,722.42. A number like that could feel almost unreal to someone who remembered 1982. Less than 5 years earlier, the Dow had been under 800. Now the market seemed to be standing on a platform built of recovery, policy, innovation, debt, takeover fever, foreign investment, retirement money and belief. But a platform made of many materials can be difficult to inspect. You may know it is tall. You may not know where the weakest plank is. The last weeks before the crash did not yet feel like the end of an era. They felt like uneasiness interrupting success. That distinction matters. People can tolerate uneasiness if they believe the larger story remains intact. A bad day in September could be explained. A sell-off in early October could be called healthy. A drop after a long rise can be described as overdue. The language of markets is full of phrases that make pain sound orderly. Consolidation, correction, profit-taking, rotation, cooling off. These words are not useless. Sometimes they are exactly right, but they can also become a way of soothing people while the ground changes under them. Imagine a broker in September 1987 speaking to a nervous client. He has the chart in front of him. He knows the market has come a long way. He may even personally think prices are high, but he also knows the client has made money. He knows the client likes hearing confidence. He says the market is volatile, but the economy is still functioning. He says pullbacks happen. He says long-term investors should not overreact, and perhaps he believes every word. That is the important part. The danger in history does not always come from lies. Sometimes it comes from true statements arranged in a way that hides the larger risk. Yes, pullbacks happen. Yes, long-term investors should not panic. Yes, the economy was not collapsing in early October. But yes, the market had also climbed very far. Yes, new trading strategies could intensify moves. Yes, confidence had become crowded. All of these things could be true at once. For people far from Wall Street, the boom had a different texture. In the suburbs, the recovery of the 1980s showed up in shopping malls, cars, home values, television commercials, and a growing sense that success could be purchased on credit. In some towns, the decade felt prosperous. In others, especially where manufacturing had weakened, the Wall Street boom could feel like a party being held in another house. That separation is important. The stock market could be soaring while workers in certain industries felt abandoned. The language of national recovery did not fit every neighbourhood. Still, Wall Street's rise became part of the public atmosphere. Even people who mistrusted financiers could not ignore the numbers. A rising Dow was treated almost like a national scoreboard. When it went up, commentators spoke as if America itself had won something. That is why the coming fall would feel larger than a technical market event. It would feel like a crack in the story of the decade. The 1980s had told Americans, or at least tried to tell them, that confidence was practical, that markets were efficient, that finance was sophisticated, that the country had shaken off its malaise and found a harder, sharper, more profitable version of itself. Black Monday did not erase all of that in one day, but it exposed how much of the story depended on belief. And belief can disappear faster than wealth. Wealth vanishes on paper, number by number. Belief vanishes in the body. The moment people stop trusting the rise, they do not simply revise their spreadsheets. Their voices change. Their decisions change. Their hands move toward the phone. The long boom made everyone feel safe, not because everyone was careless, and not because everyone was greedy, but because the evidence of safety had been delivered again and again. Statements rose, deals succeeded, Models worked, warnings faded, pullbacks passed. The market rewarded those who stayed in and embarrassed many who stepped aside. That is how a boom educates people. It teaches lessons that are useful until the weather changes. Then the same lessons can become traps. By the time autumn settled over New York in 1987, the city had no way of knowing that it was living through the last calm stretch before a financial break people would study for decades. The restaurants were still full, the phone still rang with opportunity, the newspapers still carried takeover stories and market commentary, office lights still burned late in the towers. Traders still arrived early, joked roughly, watched screens, made calls, and spoke in the fast language of people who believed they understood the game they were playing. But under the confidence, small pressures were building. Interest rates were rising. The dollar was under strain. The trade deficit worried policymakers and investors. The market had already drifted down from its August high. The structure was still standing, but the air inside it had changed. And then came the week before the fall, when the warnings stopped being scattered and began to arrive in sequence. A tax proposal in Washington threatened the benefits that had helped fuel takeover activity. Trade deficit numbers rattled confidence. Bond yields rose. The dollar weakened. Stocks fell sharply. The language of correction began to sound thinner. People who had spent years believing that every decline was a buying opportunity started to wonder whether this decline had a different shape. The long boom had trained Wall Street to feel safe, but safety is a feeling, not a guarantee. And as that October week darkened, the market was about to discover how quickly a feeling can turn. There is a particular kind of confidence that comes when people believe they have made an old danger modern. Not removed it entirely, because no serious person on Wall Street would have said risk no longer existed, but measured it, organised it, softened it, put it into models, and given it a place on a screen where it could be watched. That was one of the quiet beliefs moving through finance in the years before Black Monday. The market might still fall, prices might still move against you, bad news might still arrive from Washington, from overseas, from the bond market, from a company's earnings report, from a currency desk in London or Tokyo. But the people running large pools of money increasingly believed they had tools their fathers and grandfathers never had. They had computers. They had index futures. They had trading formulas. They had strategies with calm names that made fear sound manageable. And of all those strategies, none mattered more to the story of October 1987 than portfolio insurance. Now, portfolio insurance is one of those phrases that sounds reassuring before you understand what it actually meant. Insurance is a friendly word. It belongs to the world of house fires, car accidents, hospital bills, and careful adults who plan ahead. It suggests that if something terrible happens, someone somewhere has promised to make you whole, or at least to keep you from being ruined. But portfolio insurance in the 1980s was not really insurance in that ordinary sense. There was no company standing behind the market with a checkbook. There was no locked box of money waiting to repair losses. Portfolio insurance was a trading strategy. It was a way for large institutions, pension funds, endowments, and other investors to try to protect a stock portfolio by selling stock index futures as the market declined. In plain language, it worked like this. If the market fell a little, the program might tell the manager to sell a little. If the market fell more, it might tell the manager to sell more. The deeper the decline, the more protection the model said was needed. By itself, that sounds reasonable. If you own a lot of stocks and the market begins to fall, reducing exposure can feel prudent. No one wants to be the person who stood still while losses grew. No pension fund manager wants to explain to a board that he saw danger coming and did nothing. The trouble was not that one investor wanted protection. The trouble was that many investors had come to depend on similar kinds of protection, and the protection often worked by adding more selling into a falling market. It was like a town where every family had been sold the same storm plan, and the plan said that at the first sign of floodwater, everyone should drive across the same narrow bridge. The bridge might handle a few cars. It might even handle many cars in good weather. But if the storm is large enough and every household moves at once, the plan becomes part of the emergency. This is the part of the story that requires us to slow down, because it is easy to blame the computers and move on. People have done that for decades. They say Black Monday was caused by machines, by program trading, by screens replacing judgment, by a market that had become too fast for human beings. There is truth in that, but only partial truth. The computers did not wake up on October 19th and decide to panic. They did not have fear in the human sense. They did not feel embarrassment, greed, dread, pride, or the cold drop in the stomach that comes when a number on a screen moves against you too quickly. People built the systems. People trusted the models. People entered the instructions. People believed that the past could be used to shape a safe path through the future. The machines were not separate from human confidence. They were an extension of it. Wall Street in 1987 was standing between two worlds. On the floor of the New York Stock Exchange, trading was still physical. Men and women stood shoulder to shoulder. Specialists gathered order books. Clocks ran paper from one point to another. Telephones rang. Human voices carried prices across crowded rooms. A person could still smell the floor, still see the sweat, still hear the shouting, still watch faces change when the market turned. But behind that old physical world, a newer world had grown quickly. Computers calculated relationships between futures and stocks. Large institutions could send orders in volume. Index futures traded in Chicago gave investors a way to bet on or hedge the whole market rather than one company at a time. Program trading connected decisions across markets. A movement in one place could produce action in another. A price in Chicago could pressure expectations in New York. A model in an office could become an order on an exchange. The market was not yet the silent electronic machine we know today, but it was no longer the slower market older traders had grown up inside. For many professionals, this was progress, and in ordinary conditions it really was useful. Index futures allowed investors to hedge broad exposure quickly. Program trading could exploit price differences between futures and baskets of stocks, helping to link markets that might otherwise drift apart. Computers made calculations faster and more accurate. A large portfolio could be monitored with a precision that would have been difficult only a generation earlier. If you managed billions of dollars, this mattered. You needed tools that matched the size of the money under your care. No one wanted to go back to a world where every adjustment required a slow, manual process and a room full of clerks with adding machines. The new tools did real work. But tools also change behaviour. That is something history teaches again and again. When people are given a faster way to do something, they do not simply do the old thing more efficiently. They begin to think differently because the faster thing exists. A trader with a telephone behaves differently from a trader waiting on a messenger. A fund manager with index futures behaves differently from one who can only sell individual stocks one at a time. A pension fund with a portfolio insurance program behaves differently from one that has to make every defensive decision through conversation, hesitation, and judgment. Speed changes the mind. It shortens the distance between fear and action. Think about a household before modern banking. If a family wanted to move money, they might have to go to a bank, sign forms, speak to a person, wait. That friction could be annoying, but it also slowed emotion. Now think about a person today who can move money with a few taps on a phone at midnight while anxious and tired. The tool does not create the anxiety, but it gives the anxiety a clean path. Wall Street in 1987 was experiencing a version of that transformation. The fear was old. The route was new. Portfolio insurance became popular because it offered something almost irresistible. It told large investors they could stay in the rising market without feeling fully exposed to a collapse. That was the dream. You did not have to sell too early and miss the gains. You did not have to sit in cash while everyone else got richer. You could remain invested, collect the upside, and trust the strategy to reduce losses if prices turned down. It felt like a way to have courage without paying the full price of courage, And in a long bull market, that promise was powerful. The market kept going up, and the protection sat there like an umbrella under a clear sky. You were glad to own it, but you rarely had to test it. There is something very human about that. We all have plans we've never had to use. A fire escape route, a spare tyre, a savings account for emergencies, a phone number written down in case something goes wrong. Having the plan makes us feel safer, and sometimes it truly does make us safer. But some plans only work if very few people need them at the same time. That is the uncomfortable lesson. A fire exit works because people move through it in an orderly way. A bank can honour withdrawals because not every depositor arrives at once. A market can absorb selling because buyers exist on the other side at prices that are not too far away. When too many people act on the same emergency plan together, the plan is no longer a private shield. It becomes a public force. By 1987, the stock market had become increasingly tied to the futures market. The S&P 500 futures contract traded in Chicago allowed institutions to move quickly against the broad market. If a portfolio insurance model called for reducing stock exposure, selling futures could be faster than selling every individual stock in a portfolio. That speed was the attraction. But speed also meant that selling pressure could appear in the futures market first, pushing futures prices down. Then program traders, seeing the relationship between futures and the underlying stocks move out of line, could sell stocks or buy futures to exploit the gap. What looked like a technical imbalance could feed back into the cash market. The systems were connected, and on a normal day that connection helped keep prices aligned. On a panicked day, the connection could transmit pressure. This sounds technical, so let's put it inside a room. Imagine a portfolio manager sitting in an office in 1987, responsible for a pension fund. This is not play money. It is the retirement future of workers, people who may never know his name but whose lives are partly tied to his decisions. He has enjoyed the bull market. His fund has grown. He has been praised for staying invested. But he also knows that if the market drops hard, he will be asked why he did not protect the portfolio. So he has adopted a strategy. The model says that at certain market levels, he should hedge. The decision has already been partly made in advance. That is the point of the system. It removes hesitation. It turns a frightening moment into a rule. Now the market begins to fall. The screen shows losses. The phone rings. A colleague asks whether the trigger has been reached. The model says sell. Not because the manager is panicking in the old-fashioned sense, not because he has lost all discipline, but because discipline now means obeying the model. He sells futures to hedge. Somewhere else, another manager does the same. Somewhere else, another. Each one is acting responsibly according to the system he adopted. None of them intends to crash the market. But the market does not care about intentions. It receives the orders. This is one of the most important distinctions in the story of Black Monday. The disaster was not simply a crowd of irrational people screaming and dumping stocks. There was irrational fear, yes. There was human panic, certainly. But there was also rule-based selling. There were strategies that transformed market declines into additional sell orders. There were systems designed to manage risk at the level of one institution that could increase pressure at the level of the whole market. That is a much more complicated and more useful lesson than saying people lost their minds. Sometimes people follow their plans, and the plans themselves become dangerous because too many people are following versions of the same one. The confidence behind these systems was not entirely foolish. The people who created portfolio insurance included serious academics and financial professionals. They used mathematical ideas that had reshaped modern finance, including option pricing theory. They looked at markets in terms of dynamic hedging, adjusting exposure as prices changed. This was sophisticated work. It was not backroom superstition. That is exactly why people trusted it. A strategy with equations behind it can feel more honest than a trader's instinct. A spreadsheet can seem less emotional than a man on a trading floor. A formula can look like the opposite of panic. But a formula still rests on assumptions. It assumes that markets will remain liquid enough. It assumes that trades can be executed near expected prices. It assumes that price changes will not gap too far too quickly. It assumes that the exit will still be there when you need to use it. On October 19th, those assumptions were placed under pressure. Liquidity, that plain word that means the ability to buy or sell without destroying the price, began to matter more than almost anything else. In a rising market, liquidity is easy to take for granted. Buyers seem to appear, orders get filled, prices move, but not in a way that makes the whole system feel brittle. In a crash, liquidity can vanish like a person leaving a room without saying goodbye. The screen may show a price, but when you try to trade at that price, the market has already moved. The buyer you expected is gone, the bid is lower, or there is no real bid in the size you need. This is when the difference between theory and practice becomes painfully clear. A model may tell you to sell a certain amount. It cannot guarantee that the market will receive that sale gently. There was another problem. The markets were fragmented. Stocks traded on the New York Stock Exchange and other stock markets. Futures traded in Chicago. Options traded elsewhere. Each market had its own rules, its own specialists, its own opening procedures, its own pressures, its own sense of what was happening. The financial system had become connected economically before it became fully coordinated operationally. Prices in one market influence prices in another, but the people responsible for keeping each market orderly did not necessarily share a single command center or a single view of the danger. It was like several crews trying to manage connected rooms in the same flooding building, each with its own pumps, its own gauges, and its own shouted instructions. The water moved between rooms whether the crews were ready or not. This is why the phrase market mechanisms mattered so much after the crash. It was not enough to ask why investors wanted to sell. People sell for many reasons. The harder question was why the selling became so sudden, so disorderly, so self-reinforcing. The mechanisms of the market, the ways orders moved, the ways futures and stocks interacted, the ways specialists handled imbalances, the ways institutions responded to price declines, all of those details turned out to matter. They were not boring plumbing beneath the real story. They were the story. Plumbing only seems boring until the house floods. And yet, inside the offices where these systems were used, the atmosphere before the crash was not one of reckless stupidity. It was professional confidence. That distinction matters. The people involved had meetings, memoranda, models, consultants, presentations, and explanations. Portfolio insurance was sold to serious institutions in serious language. Program trading was discussed as efficiency. Index arbitrage was a technique. Futures were instruments. Hedging was prudence. None of the words sounded wild. That is one of the reasons financial danger can grow quietly. By the time something has a respectable vocabulary, it can spread through institutions that would never describe themselves as gamblers. Let me ask you something for a moment. Have you ever trusted a system so completely that you stopped noticing the assumptions behind it? Maybe a navigation app that told you the fastest route until the road was closed and you realized you had no idea where you were. Maybe an automatic bill payment that worked for years until one small error caused a larger problem. Maybe a calendar reminder, a password manager, a backup drive, an alarm clock, something that made life easier because you no longer had to hold the whole process in your mind. Most of the time, that trust is reasonable. Modern life requires it. But when the system fails, or when too many people depend on the same system under stress, you suddenly see how much of your confidence had been outsourced. Wall Street had outsourced part of its confidence to machines and models. On ordinary days, that looked like progress. On Black Monday, it looked like speed. The speed changed the emotional experience of the market. Older panics had their own terror, of course. In 1929, crowds gathered outside the exchange and brokerage offices. Ticker tapes ran late. Rumours spread through telephone calls and newspapers. People watched numbers arrive after the fact and tried to understand what had already happened. By 1987, the numbers came faster. Screens showed the damage as it formed. Futures could drop before individual stocks opened. Index levels could flash across terminals. The market became more visible in real time, and real-time visibility is not always calming. Watching a slow disaster unfold second by second can make people feel informed, but it can also make them feel trapped inside the movement. There is a particular cruelty in seeing the loss update continuously. A long-term investor may tell himself he is patient, but patience is easier when the statement comes once a quarter. It is harder when the red numbers move every minute. Professionals are supposed to be trained for that, and many are. But training does not make a person immune to pressure. It only gives him a script to follow while pressure rises. In 1987, the script increasingly involved more selling, more hedging, more calls, more explanations, more attempts to keep up with a market that was moving faster than the conversations around it. The technology also created distance. A pension fund manager selling futures in Chicago did not have to look into the face of the specialist in New York, who would later struggle with the pressure on individual stocks. A computer-generated order did not carry the tremor of a human voice. A strategy executed through markets could feel cleaner than telling a broker, "Sell as much as you can before this gets worse." But the effect could be the same or stronger. Modern finance often separates action from consequence by layers of systems. That separation makes large markets possible. It also allows decisions to accumulate in ways that feel impersonal until the consequences arrive all at once. On the floor, though, nothing felt impersonal. The floor felt crowded, loud, hot, and increasingly strained. Specialists were expected to maintain orderly markets in their assigned stocks, buying and selling from their own accounts when necessary to smooth trading. That role worked best when order imbalances were manageable. But on a day when sell orders overwhelmed buyers, the specialist system faced pressure it had not been built to absorb in that size and speed. Some stocks opened late, some prices moved sharply. Orders that looked similar could receive very different executions depending on timing and market conditions. People later examined these details in reports, charts, and testimony, but on the day itself, those details were lived as confusion. A trader did not need a formal study to know the market was not behaving normally. He could hear it. The phones were another part of the machinery. Every ringing phone carried another human demand. A client wanted a price. A client wanted out. A client wanted reassurance. A manager wanted to know whether an order had been completed. Someone wanted to know why a stock had not opened. Someone wanted to know whether the futures were leading the stocks or the stocks were leading the futures. Someone wanted an explanation, and explanations were hard to give while the thing being explained was still moving. The faster the market moved, the more speech failed. Words lagged behind prices. By the time a broker described one level, the screen had found another. That gap between language and price is one of the hidden terrors of market crashes. Finance depends on naming things. A stock is worth this. A portfolio has lost that. The Dow is down this many points. The futures imply that. A bid is here, an offer is there. But when prices move too quickly, words become stale almost as soon as they leave the mouth. You can feel authority draining out of the room when people cannot speak fast enough to describe what is happening. In that space, rumour grows. So does imagination. And imagination, during a panic, usually looks downward. Still, even in those moments, people searched for reason. They asked whether the decline was about interest rates, the dollar, trade deficits, taxes, takeover regulation, overvaluation, program trading, portfolio insurance, foreign markets, or simple fear. The answer, frustratingly, was yes in different measures. Financial events rarely have one cause, no matter how much people want one. A single cause is comforting because it can be blamed, fixed, banned, or mocked. Black Monday resisted that simplicity. The market was already vulnerable after a long rise. Macro concerns had unsettled investors. The previous week had damaged confidence. Foreign markets were falling. Portfolio insurance and program trading added mechanical selling pressure. Futures and stocks interacted in destabilizing ways. Market-making systems struggled. Human fear did the rest. The crash was not one match dropped into dry grass. It was dry grass, wind, heat, and then many sparks. By the time people later studied the event, they could see that some of the very tools designed to make markets more efficient had helped transmit stress. That does not mean efficiency was bad. It means efficiency under normal conditions can become fragility under extreme conditions. A tightly connected system moves information quickly. It also moves panic quickly. A market that links New York, Chicago, London, and Tokyo can distribute opportunity across the world. It can also distribute fear across the world. The same roads that carry food into a city can carry an invading army. The road is not good or evil. Its importance depends on what travels over it. In the years before Black Monday, Wall Street had learned to admire speed, fast information, fast execution, fast hedging, fast arbitrage, fast response. Slow judgment began to feel like weakness in a world where prices moved before committees could finish meeting. But speed has a cost. It gives less time for doubt, less time for a second thought, less time for someone to say, wait, what happens if everyone does this? That question, simple as it sounds, was one of the questions October 1987 forced into the open. What happens if everyone's private protection becomes public selling? What happens if every model assumes liquidity that disappears? What happens if markets are connected enough to pull one another down, but not coordinated enough to pause together? What happens if confidence travels by machine and fear arrives even faster? There is an image I keep returning to when thinking about the new technology of that era. Not a supercomputer in a dark room, not a glowing wall of numbers, not the sleek digital world we associate with finance today. I picture a printer. A plain office printer in 1987, spitting out instructions, reports, order lists, risk levels, things that looked official because they were printed cleanly on paper. Someone tears the sheet off. Someone reads the number. Someone picks up a phone. The machine has not screamed. It has not panicked. It has simply produced the next instruction. That quietness is what makes it unsettling. Fear no longer had to look like a man shouting across a crowd. It could look like a line of output from a system everyone had agreed to trust. And around that system were people trying to behave professionally. A trader might curse the machines and still depend on them. A manager might distrust the model and still fear the consequences of ignoring it. A firm might believe program trading was being blamed unfairly while still knowing that the public would want an explanation. Regulators watching the break unfold had to understand a market more complex than the one their predecessors had supervised. The old image of Wall Street as a place where individual stock traders haggled over shares was no longer enough. The market had become a set of linked mechanisms, and on the worst day, those mechanisms had shown that they could reinforce one another's distress. It would be too easy and too comforting to say that 1987 was the moment Wall Street learned humility. It did learn some things. Circuit breakers would later be introduced. Regulators would pay closer attention to the connections between markets. The phrase program trading would become a public villain for a time. Portfolio insurance would lose much of its glamour. But finance has a short memory when profits return. That is part of the larger story. The tools change, the names change, the screens become faster and thinner, the formulas more advanced, the servers closer to exchanges, the language more technical. But the underlying human desire remains recognizable. We still want protection without retreat. We still want upside without full danger. We still want systems that let us believe the old fears have been contained. By the middle of October 1987, that desire had helped create a market that could move with startling speed. The long boom had made people feel safe, and the new technology had made that safety feel engineered. The two ideas worked together. Confidence made investors willing to stay exposed. Computers and hedging strategies made that exposure feel controlled. Rising prices confirmed the confidence. The confidence justified the tools. The tools allowed more confidence. It was a loop, and for a while it felt intelligent. Then the market began to fall, and the loop changed direction. That is the frightening thing about systems built around feedback. They can reinforce success on the way up and pressure on the way down. The same market that had rewarded speed now revealed the danger of speed. The same futures contracts that helped institutions hedge now became channels for selling pressure. The same computer models that promised discipline now produced orders into a frightened market. The same confidence that had made risk feel manageable now made the shock feel worse, because people had not imagined the protection itself could become part of the problem. As the week before Black Monday approached, these forces were already waiting inside the market. They were not visible in the way a storm cloud is visible. You could not stand on Broad Street, look up and see portfolio insurance hanging over the exchange. You could not hear program trading in the wind. The city looked like itself. Offices opened. Terminals glowed. Traders joked. Analysts wrote notes. Clients called. The systems worked because the day had not yet arrived that would test them fully. But under the ordinary noise of Wall Street, the market had become faster, more connected, more confident and more fragile than many people understood. The pressure that would break open on Monday did not begin on Monday. It was already moving through the wires, the models, the futures pits, the trading desks, and the quiet assumptions of people who believed they had found a modern answer to an ancient fear. And then Friday came, bringing the kind of warning that feels serious at the time but only becomes unmistakable after everyone has already lived through what followed. Friday, October 16th, 1987, began with the uneasy feeling that Wall Street already knew how to explain. That is one of the small dangers of professional life in a place built around money. People develop language for trouble. They learn how to make fear sound organised. They can take a bad market and call it a correction. They can take a nervous room and call it volatility. They can take a sudden loss and describe it as profit-taking, as if the whole thing were tidy and voluntary, as if thousands of people had simply reached for their winnings at the same moment and politely stepped away from the table. On that Friday morning, the people arriving at trading desks, brokerage offices, futures pits and bank conference rooms were not walking into calm. They were walking into a market that had already been hit for several days. But there was still a difference between a market under pressure and a market in collapse. Most people still believed they were dealing with the first one. The second one was waiting on the other side of the weekend. It helps to remember what a Friday means on Wall Street. Monday carries the beginning of things. Tuesday and Wednesday belong to the machinery of the week. Thursday often feels like the last full day of serious positioning, but Friday has its own psychology. People do not stop caring about money because the weekend is coming, but the knowledge of the weekend changes the room. Traders want to know what they are carrying home. Fund managers want to know what risks they will have to live with for 2 days while markets are closed. Clients who might have waited on a Tuesday become more urgent on a Friday, because there is no Saturday morning session in which to change their minds. A position that feels uncomfortable at 10 o'clock in the morning feels heavier by 3 o'clock in the afternoon. And if the market is falling, Friday can become a very particular kind of trap. You're not only worried about the price in front of you. You're worried about being locked inside that price while the rest of the world keeps thinking, talking, publishing, and panicking before the market opens again. That week had already given Wall Street reasons to be nervous. The trouble had not started with a single dramatic announcement, the kind of news that makes everyone point to one headline and say, "There, that was the cause." It came from several directions at once, which is often more unsettling. On Wednesday, investors were shaken by reports that a tax proposal in Washington could remove certain benefits connected to the financing of mergers and takeovers. That may sound dry, almost painfully technical, but in the world of 1987 it mattered a great deal. Takeover activity had been one of the engines of the bull market. When investors believed a company might be bought, its stock could rise. When they believed the rules of financing those takeovers might change, the value of that possibility could shrink quickly. A stock that had been lifted by the hope of a bid could fall when the hope became less likely. And because takeover fever had touched so many corners of the market, the worry spread farther than a single company or sector. At the same time, the trade deficit remained a constant problem in the background. The United States was buying more from abroad than it was selling, and policymakers were under pressure to respond. Currency values, interest rates, and trade policy were all tied together in a way that ordinary Americans did not usually follow closely, but that markets watched with great attention. When the dollar moved, investors noticed. When bond yields rose, investors noticed. When foreign confidence in American assets seemed uncertain, investors noticed. The stock market had spent years rising partly because money had been willing to believe in American growth, American companies, and American financial leadership. But that belief did not exist in a vacuum. It depended on inflation, interest rates, currency policy, and the willingness of buyers around the world to keep treating the United States as a safe and profitable place to place capital. By Friday, the room was full of explanations, and the explanations did not calm people as much as they were supposed to. That is another thing worth understanding. A market can have reasons for falling and still feel frightening. In ordinary life, explanation often helps. If a strange noise in the house turns out to be the heater, you relax. If a delay turns out to be traffic, you adjust. But in markets, sometimes an explanation only shows how many other people may be thinking the same thing at the same time. If stocks are falling because interest rates are rising, then how many investors will decide bonds look safer? If takeover stocks are falling because Washington may change the tax treatment of deals, then how many funds will have to reduce positions built around mergers? If the dollar is under pressure, then how many foreign investors will step back? The explanation does not end the fear. It gives the fear a map. The previous days had damaged confidence in stages. That matters because people rarely move from comfort to panic in one step. They resist it. They negotiate with the facts. On the first bad day, they say the market was due for a pause. On the second, they say prices had run too far. On the third, they say the selling is healthy because it clears out weak hands. These phrases are not always dishonest. Sometimes they are true. Markets do correct. Prices do become overextended. Selling can be healthy. But when a market is already stretched by years of gains, when new trading systems are ready to respond mechanically, and when large investors are watching the same signals, the comforting language begins to wear thin. By Friday morning, even people who wanted to sound steady had to admit that the week had changed the tone. Picture a brokerage office that morning, not the famous exchange floor, just an office where brokers handled clients who trusted them or at least depended on them. The fluorescent lights are on. The desks are crowded. Newspapers sit folded open to the business pages. Quotron terminals glow with prices. Coffee cups gather near phones. The brokers arrive knowing they will spend much of the day explaining a market they do not control. Some clients want reassurance. Some want to sell. Some want to know whether this is the beginning of something worse. The broker has to answer in a way that sounds useful. He cannot simply say, "I do not know," even if that is the honest answer underneath everything else. He says the market is weak. He says there is pressure. He says we're watching key levels. He says long-term investors should not overreact. He says there may be bargains after the decline, and perhaps he believes some of it. But each time the phone rings again, the same conversation has to be performed with slightly less certainty. On the trading floor, the pressure was more direct. The market had not lost its structure yet, but the structure was working harder. Sell orders came in. Buyers became more careful. Specialists watched imbalances build. Futures prices put additional pressure on expectations. People looked at screens and at one another, and one of the most important things they were watching was not just price, it was behaviour. Were buyers stepping in? Were large institutions supporting the market? Were the declines orderly? Were certain stocks holding better than others? Were the futures leading the cash market lower? Were clients panicking or merely adjusting? This kind of watching is difficult to describe because it depends on experience. Traders learn to read the room the way a farmer reads weather. A sky can be grey without being dangerous. A wind can shift without becoming a storm. But there are days when the air feels wrong before the rain arrives. That Friday had that kind of feeling. It was not yet the great break, but it carried the sense that something had become less reliable. The Dow fell hard, losing more than 100 points, a decline of about 4.6% by the close. Today, a 100-point move in the Dow does not mean what it meant then because the index is much larger now. But in 1987, the number landed heavily. It was the largest one-day point decline in the Dow's history up to that time. A record like that changes the way people speak. It gives anxiety a headline. It takes a private worry that had been moving through trading rooms and turns it into public fact. The market did not simply drift lower. It broke a record in the wrong direction. And still, even then, many people did not think Monday would bring disaster. That is important. They knew Friday was bad. They knew the week was bad. They knew the market had fallen sharply from its August high. But a crash of the size that came on Monday was not the ordinary expectation. People often assume that history announces itself clearly in advance. It does not. Friday looked frightening, but frightening is not the same as unimaginable. A trader leaving work that evening might expect more volatility on Monday. A fund manager might expect a rough opening. A broker might expect clients to call over the weekend. But almost no one walked out thinking that the Dow would lose more than 22% in the next session. The mind protects itself from numbers that large. It treats them as theoretical until reality forces them into the room. The closing bell on Friday did not bring relief in the normal way. Usually after a hard trading day ends, there is at least a temporary release. The phone's slow, people step away from screens, someone loosens a tie, someone goes for a drink, someone says, well, at least that is over. But on October 16th, it was not over in the way that mattered. The market was closed, yes. The official prices were printed, yes. But thought did not stop. The weekend became part of the crisis. This is one of the strangest features of that moment. The market could not trade on Saturday or Sunday, but fear could. Newspapers could print. Television could analyse. Treasury officials could speak. Foreign markets could prepare. Investors could call one another. Portfolio managers could run scenarios. Clients could leave messages. Wives and husbands could ask what the losses meant. The exchange was closed, but the story was still moving. Imagine a trader leaving Lower Manhattan that Friday evening. He steps outside after hours of noise into the city air. Maybe it is cool. October in New York has that particular feeling. Summer gone, winter not yet present. The city still busy, but the light changing earlier. He may pass people who know nothing about the details of his day. Someone is buying flowers. Someone is arguing over a taxi. Someone is carrying groceries. The subway is crowded with people whose jobs have nothing to do with futures contracts or takeover tax provisions. The trader has numbers in his head that do not belong to them, at least not yet. He knows the Dow fell more than 100 points. He knows clients are frightened. He knows the firm will have meetings. He knows Monday may be rough. But he also knows it is Friday night. The human mind does odd things with that. It wants the weekend to remain the weekend, even when the week has followed you home. Some people did go out. Restaurants in New York still filled. Drinks were ordered. Conversations happened in low, serious voices at tables, where men who had spent years celebrating the market now tried to decide whether they were seeing a buying opportunity or the beginning of something much larger. In the 1980s Wall Street culture, confidence was not merely a professional tool, it was a social expectation. To sound frightened was to give something away. So people joked, they exaggerated, they cursed the market, they blamed Washington, computers, foreigners, the bond market, portfolio insurance, program traders, the press. anyone useful. Blame is one of the ways people keep fear from becoming too personal. If you can blame something clearly, you do not have to say, "I am afraid the thing I trusted may not hold." In houses far from New York, the worry arrived more slowly. Evening news broadcasts reported the sharp decline. Newspapers prepared weekend editions with serious market coverage. Ordinary investors who had followed the bull market with growing interest now heard that the Dow had suffered a historic point drop. Some had brokers to call. Some had mutual funds and could only wonder. Some had no direct investments but understood, vaguely and correctly, that when Wall Street has a very bad day, the consequences do not always stay on Wall Street. That is how financial fear spreads beyond the people who created or understand the instruments involved. It enters living rooms through a number. It enters conversations through a headline. It enters the body as a question that is hard to answer. Are we safe? The weekend gave that question time to grow. On Saturday, Treasury Secretary James Baker made comments suggesting the United States might allow or encourage the dollar to fall if West Germany did not cooperate more on economic policy. This mattered because currency policy was already one of the market's sore spots. Investors were concerned about the dollar, interest rates, inflation, and international coordination. A public statement from a senior official did not calm that concern, it added to it. To people outside finance, a discussion about the dollar can sound distant. But to global investors, the dollar is not distant. It affects returns, it affects confidence, it affects the appeal of American assets. If foreign investors fear that the currency in which their investments are denominated may weaken, they have another reason to sell or step away. On an ordinary weekend, Baker's comments might have been debated in policy circles and absorbed by markets in a measured way. On this weekend, they landed on a market already bruised. This is where the weekend becomes almost painful to imagine. No one could trade ordinary stocks on the New York Stock Exchange, but people could think about trading. They could prepare orders. They could decide what they wanted to do at Monday's open. They could watch overseas markets and take signals from them. They could talk themselves into caution or out of courage. A market break often feeds on immediacy, but this one also fed on the pause. The pause did not soothe people. It gave them time to decide they did not want to be exposed when the doors opened again. By Sunday night, the problem was no longer only what had happened on Friday. It was what people intended to do because of Friday. Think about the emotional mechanics of that. A fund manager has 2 days to look at the numbers. He sees the market has fallen sharply. He sees the year's gains under pressure. He knows clients may redeem. He knows his peers may sell. He knows overseas markets may open weak. He knows portfolio insurance triggers may require action if prices fall further. He does not want to be reckless, but he also does not want to be the last person to reduce risk. In markets, being early can be embarrassing, but being late can be ruinous. The weekend turns that calculation over and over. By Monday morning, many people are no longer simply reacting to Friday's decline. They are reacting to what they imagine everyone else will do in response to it. That is one of the central facts of panic. People fear the event, and then they fear the crowd's reaction to the event. Then the crowd's reaction becomes the event. By the end of the weekend, Wall Street had entered that dangerous territory. The Friday decline had created losses. The losses created concern. The concern created conversations. The conversations created expectations of more selling. The expectation of more selling made selling feel prudent. And when selling feels prudent to too many people at once, prudence becomes pressure. Inside the firms there would have been meetings and calls, some formal, some hurried, some calm, some tense. Senior managers wanted to understand exposure. Trading desks wanted to know order flow. Salespeople wanted guidance for clients. Risk people wanted numbers. In an age before email filled every hour, much of this moved through phones, faxes, printouts, and in-person conversations. A person might carry a stack of paper from one office to another, each page bearing numbers that seemed to explain something but never enough. How much exposure did clients have? how much selling might arrive. How much could the market absorb? Where were futures likely to open? Which stocks had the largest imbalances? How would overseas markets behave? The questions multiplied because there was no one answer that settled the matter. Some professionals surely told themselves that Monday might bring a rebound. There were reasons to believe that. Markets often bounce after sharp drops. Bargain hunters sometimes step in. A weekend can cool emotion. Officials can make reassuring statements. Large institutions may decide prices have become attractive. There is almost always a case for hope, and hope in markets often wears the clothes of analysis. A person can point to earnings, economic growth, historical patterns, valuation after a decline, and say the selling has gone too far. He may not be foolish. He may even be right eventually. But timing matters. Being right about long-term value does not protect you from forced selling on Monday morning. It does not stop a client from demanding cash. It does not stop a model from issuing instructions. It does not stop other people from deciding they cannot wait to find out. There is a quieter human side to that weekend as well. People who worked in the market had families. They had dinners, children, errands, parents, plans. A broker might spend Saturday at home trying to act normal while thinking about client accounts. A trader might sit in front of a television and barely hear what his family was saying. A fund manager might go to a child's soccer game and find himself replaying price levels instead of watching the field. This is not to make them victims in some exaggerated way. Many of these people were well paid. Many had chosen the pressure, but pressure does not become unreal because the salary is high. The body still carries it. The mind still circles back. The weekend before Black Monday was not a rest. For many people in finance, it was an interval of waiting with no useful action available. That lack of action matters. During market hours, a trader can do something even if the thing is wrong. He can buy, sell, quote, call, hedge, cancel, argue, move. During the weekend, he mostly thinks. And thinking without action can intensify fear. It allows imagination to widen the possible damage. It lets Friday's numbers sit on the table and become larger in meaning. It lets every article, every comment, every rumour attach itself to the same worry. By Sunday evening, the market had become a coiled thing. The orders had not yet hit, but many decisions had already been made in private. The opening bell on Monday would not create all of that fear. It would reveal it. Outside the United States, the world was watching as well. Financial markets were connected enough that New York's Friday could become another market's Monday before Wall Street reopened. Time zones mattered. Selling could begin elsewhere while Americans slept or prepared for work. That was one of the realities of the new global market. The United States was still central, but it was not alone. Investors in Asia and Europe could respond to Wall Street's weakness, and their responses could then feed back into expectations in New York. Fear did not need to wait at the edge of the Atlantic. It could travel by screen, cable, and newswire. The weekend was not a wall. It was a corridor. By Sunday night, some people were looking at indications from overseas and feeling the nervousness harden. If foreign markets opened weak, if the dollar remained under pressure, if futures suggested a lower opening, then Monday would begin with sell orders already stacked in the mind before they were visible on the floor. In that sense, the crash began before the opening bell. Not in the official numbers, not in the charts historians would later mark, but in the decisions forming in offices, homes, and hotel rooms. Sell at the open. Hedge more aggressively. Reduce exposure. Wait for a better level before buying. Do not step in too early. Let others absorb the first wave. Each decision made sense to the person making it. Together they formed the first shape of the morning. And all of this happened while the American public still had only a partial view. A person reading the Sunday paper might see concern but not catastrophe. A family might discuss the market over breakfast and then move on to church, errands, football, yard work, laundry, the ordinary architecture of a weekend. That is one of the strange things about historical moments. These signs can be present without being fully readable. Most people do not know they are living in the hours before a named event. They only know something seems unsettled. The title comes later. Black Monday was not yet Black Monday. It was simply the next trading day after a terrible Friday. On Wall Street, the terrible Friday had changed the meaning of Monday morning. The opening would not be routine. Firms would arrive early. Traders would watch overseas markets and futures with unusual attention. Specialists would prepare for imbalances. Brokers would expect calls before coffee. Reporters would listen for words that sounded larger than a correction. Officials would watch the machinery. The market had ended the week wounded, and the weekend had not healed it. It had given the wound time to be examined, discussed, feared, and pressed by every hand that could not leave it alone. The fall was not inevitable in the simple sense. History rarely is. Different comments from officials, different order flows, different levels of confidence, different responses from buyers. Any of these might have changed the shape of what came next. But by the close of Friday, October 16th, the ingredients were no longer scattered. They had been brought into the same room. A long bull market that had lifted prices far beyond their old levels. Rising concern about interest rates and the dollar. A takeover boom suddenly threatened by tax policy. Program trading and portfolio insurance ready to transmit selling. A global market able to carry fear across time zones. A public beginning to hear the wrong kind of records being broken. And thousands of professionals facing a weekend in which they could not trade, but could imagine very clearly what they might need to do when trading resumed. So the weekend passed, not quietly exactly, but with the strange muted noise of a machine waiting to restart. On Sunday night, lights burned in offices where people wanted one more look at the numbers. Telephones rang in homes where no one wanted another call. Newspapers lay folded on kitchen tables. Television sets carried business commentary to people who understood some of it and felt the rest. In Lower Manhattan, the exchange itself stood dark and still, its floor empty, its posts silent, its phones waiting. Nothing was moving there yet. No crowd was shouting. No specialist was trying to find a price. No clerk was pushing through bodies with an order slip in hand. But the selling pressure was already gathering beyond the doors, and by morning, when the people returned and the bell rang, Wall Street would discover that Friday had not been the end of the decline. It had been the last warning before the market opened into something no one in that building would ever forget. Monday morning arrived with the kind of ordinary cruelty that history often has. The city did not wake up with thunder. There was no warning siren over Lower Manhattan, no dark cloud sitting over the New York Stock Exchange, no voice coming through every radio at breakfast telling people that the day ahead would become one of the most frightening financial days in American history. It was simply Monday, October 19th, 1987. People buttoned shirts, tightened ties, stepped into elevators, bought coffee, unfolded newspapers, checked watches, and moved toward work in the usual tired rhythm of the beginning of the week. The streets around Wall Street filled the way they always did. Taxis nudged through traffic. Shoes struck pavement. Office doors opened. Lights came on in towers where people had spent years learning how to speak confidently about money. But inside the financial world, the morning was already wrong. The weekend had not calmed the market. It had gathered the fear and handed it back to Wall Street before the opening bell. Before trading began in New York, the bad news had already travelled around the world. Markets overseas had fallen. The pressure that had started building the week before had not been contained by distance or sleep. It had crossed time zones, moved through foreign exchanges, passed into futures markets, and arrived back in America with a message that no one wanted to hear. The selling was not finished. The market was not going to open into relief. It was going to open into a crowd trying to leave at once. And this is one of the hardest things to understand if you have never watched a market break from the inside. The fear begins before the official numbers appear. It begins in the order book. It begins in the imbalance. It begins when people who are supposed to make a market can see that the sell orders are there, waiting, heavy and impatient, while the buyers are either absent or standing far below the last price anyone remembers as normal. The New York Stock Exchange opened at 9:30 in the morning, but many stocks did not truly open with it. That is one of the small details that reveals how strained the system already was. A stock can have a listed price from the previous session, and yet at the opening bell, not have a real new price, because no orderly match exists between people desperate to sell and people willing to buy. On a calm morning, this is not a dramatic problem. Specialists work through orders, prices are set, trading begins. But on Black Monday, the imbalances were too large in too many important stocks. Some of the most familiar names in American business stood there unopened, not because nothing was happening, but because too much was happening on one side of the market. The silence in those stocks was not calm. It was pressure without a release. Imagine standing on the floor at that moment. The room is loud, but the noise is not the usual noise. A trading floor always sounds chaotic to outsiders. Even on ordinary days, it can seem like confusion wearing jackets and badges. But the people who work there knew the normal rhythm. They knew which shouts mattered, which gestures were routine, which bursts of anger would disappear in 30 seconds, which crowd at a post was ordinary and which one was trouble. On that morning, too many things were trouble at once. Phones were ringing without mercy. Clerks were pushing through bodies with orders that seemed to age as they moved. Traders were looking at screens, then at one another, then back at screens, trying to understand whether the prices being shown still meant what prices were supposed to mean. Some stocks had not opened. Futures had opened and were already lower. The visible market and the expected market were separating from each other, and that separation created its own fear. By 10 o'clock, the problem was obvious enough that no one could mistake it for a normal week opening. Dozens of major stocks still had not opened. The indexes, which depended on the last available prices of their component stocks, were giving a picture that was partly stale. That may sound technical, but inside a crash it matters deeply. If a stock has not traded yet, the index may still be using Friday's price, even though everyone in the room knows that if the stock did open, it would open much lower. So the official number can look less terrible than the real pressure underneath it. It is like looking at a house from the street and seeing the front wall still standing, while everyone inside knows the back rooms are already collapsing. Meanwhile, the futures market, which did not have to wait for each individual stock to open, was showing the fear more directly. Futures prices fell hard. They became a kind of billboard for panic, flashing a darker message than the official stock index could yet fully admit. This created confusion and opportunity at the same time, which is a very Wall Street kind of danger. Index arbitrage traders saw gaps between futures prices and stock prices. In normal conditions, exploiting those gaps helped connect markets and keep pricing efficient. But on this morning, the gap existed partly because so many stocks had not opened, and partly because the futures market had already fallen into heavy selling. Some traders tried to sell baskets of stocks to take advantage of the difference. But when stocks finally opened, they often opened so sharply lower that the trades did not work the way they expected. Prices were not gently adjusting. They were jumping down. The normal map did not match the territory. And when the normal map fails in finance, people do not stand still and admire the complexity. They try to protect themselves. They try to reverse. They try to cover. They try to get out of the way. Every protective move becomes another movement in the crowd. There was a brief rebound later in the morning, and that is important because crashes are rarely straight lines. From far away we remember Black Monday as one long fall, and in the final number that is true. But inside the day there were moments when people hoped the market had found footing. Prices bounced. Some stocks recovered part of their opening losses. The room may have felt for a little while as if the worst had passed. That kind of hope can be almost painful in hindsight. A person sees a rebound and lets his shoulders drop a fraction. A broker tells a client there is buying coming in. A trader thinks maybe the selling was overdone. A manager wonders whether the market has flushed out the panic. Human beings are built to search for turning points. We want the moment when the bad thing stops getting worse. And for a short stretch that morning, it was possible to believe Wall Street had found one. But the selling did not stop. It changed shape and returned. Portfolio insurers, whose models had been waiting for market levels to trigger more action, began selling again as prices weakened. Some sold futures, some sold stocks, some did both. Mutual funds faced redemption pressure. Institutions that anticipated further selling wanted to get ahead of it. This is where the market became more than nervous. It became self-reinforcing. A falling price told a model to sell. The selling helped push the price lower. The lower price told someone else that more selling was coming. That person sold first. The new selling confirmed the fear. At a certain point, the question was no longer whether a particular company was worth less than it had been on Friday. The question was whether there would be enough buyers at any reasonable price to absorb the amount of stock people wanted to unload. That is the soundless terror inside a market crash. It is not only that prices fall all the time. It is that the market begins to feel one-sided. Sellers are present, urgent, and visible. Buyers become hesitant, scattered, lower, uncertain. A buyer looking at a falling market has to make a difficult decision. If he buys now and the price falls another 5%, he looks foolish within minutes. If he waits, he may get a better price. And if enough buyers wait for a better price, their waiting helps create the better price by allowing the market to fall. This is how caution turns into absence. No one has to announce that they are abandoning the market. They simply step back a few feet, and suddenly the space where buying should have been feels empty. By midday, the atmosphere was no longer merely tense. It was historic, even if no one had time to use that word properly. Reporters were calling. Executives were watching. Government officials were being briefed. The public was beginning to hear that something severe was happening, but inside the trading rooms there was no clean separation between information and panic. The news was the price, and the price was changing too quickly. The Dow was down badly. Then it was down worse. Then, after a rebound, it began moving lower again. The S&P 500 was falling. Futures were falling harder. Options markets were strained. Some derivative trading was difficult or interrupted. The different parts of the market no longer seemed like neatly connected gears. They seemed like gears grinding under pressure, some spinning too fast, some catching, some transmitting force in ways that made the whole machine shake. Think for a moment about the ordinary worker on that floor, not the famous financier, not the executive whose name might appear in the newspaper, but the clerk, the runner, the young trader, the assistant answering calls. He or she may have arrived that morning tired from a worried weekend, expecting a rough day, but not this. Now the room is hot. The noise has been going on for hours. Lunch has become irrelevant. A sandwich sits untouched somewhere. Coffee has gone cold. A phone keeps ringing. Someone wants confirmation. Someone wants a fill. Someone wants to know why an order has not been executed. Someone is angry because the price they expected no longer exists. Someone is terrified and trying to disguise it as impatience. The worker has to keep moving. The market may be falling apart, but the tasks do not stop. In fact, they multiply. Panic does not reduce work. It makes every piece of work heavier. For brokers outside the exchange, the day had its own kind of torment. They were the voice between the market and the client. They had to translate chaos into language. A client calling from a home or office might not understand why a sell order could not be completed at the price seen minutes earlier. A client might demand certainty where none existed. A broker might say, "I am trying to get you a market." He might say the stock is not open yet. He might say the price has moved. He might say there are no buyers there. Each statement would be factual, but none of them would be satisfying. People do not call their broker during a crash because they want a lecture about market structure. They call because they want control returned to them. On Black Monday, control was exactly what seemed to be disappearing, and still the numbers fell. The Dow had already lost more than anyone wanted to believe was possible for a single session, and the afternoon still stretched ahead. The terrible thing about a trading day is that it has hours. A disaster that arrives at 9:30 does not end just because everyone understands it is a disaster by noon. There is still 1 o'clock, still 2 o'clock, still 3 o'clock, still the final hour, when decisions become urgent because the close is approaching, and no one wants to carry uncertainty into the night. By early afternoon, the market had entered that exhausted stage of panic where people are no longer shocked in fresh ways. They are simply enduring the continuation. The number is lower. Then it is lower again. The face of the person beside you has become pale. The jokes have stopped working. Everyone has heard comparisons to 1929, even if they hate hearing them, and the closing bell is still too far away. There is a psychological difference between a loss that is large and a loss that seems unlimited. A person can absorb bad news if it has a shape. This much damage, this much time, this much explanation. But when the number keeps dropping, the mind begins to imagine no bottom at all. That is what made the afternoon so frightening. It was not only the percentage already lost, it was the inability to say with conviction that it would stop soon. People searched for reasons to buy and found reasons to wait. They searched for authority and found officials cautious. They searched for the old confidence of the bull market and found that it had been easier to feel when prices were rising. The last hour and a half of trading was especially brutal. The market, already badly damaged, dropped steeply again. Selling pressed harder, liquidity thinned. The Dow's decline deepened in a way that would make the final number almost unbelievable. A day that had already been terrible became worse enough to move from memory into legend. In the final hour, the market did not simply drift toward a bad close. It fell with a force that made people wonder whether the structure itself could bear the strain. This was the part of the day when exhaustion met urgency. Anyone who wanted out before the close had less and less time. Anyone considering buying had to ask why they should step in before tomorrow. Anyone using a model had to look at levels that kept demanding action. Anyone answering phones had to keep speaking while the facts changed under every sentence. At 4 o'clock, the closing bell finally rang. The market stopped trading, but the damage did not stop being understood. The Dow Jones Industrial Average closed down 508.32 points. In percentage terms, it had fallen 22.6% in one day. The S&P 500 had fallen about 20%. The losses were not a bad mood, not a temporary dip, not a correction that could be brushed aside over drinks. They were the largest one-day percentage decline in the history of the Dow. Worse than any single day in 1929. That comparison landed heavily because 1929 was the nightmare year, the reference point Americans reached for when financial fear became existential. The country had spent decades learning that 1929 was not merely a market event. It was a doorway into unemployment, bank failures, bread lines, and years of hardship. So when people heard that the percentage loss of October 19th, 1987, was even larger than the worst day of 1929, the number carried history inside it. But numbers do not fully show what it felt like. A 22.6% decline sounds precise. It looks clean in print. It can be placed on a chart, taught in a class, summarized in a paragraph. Inside the day, it was not clean. It was phones ringing and not being answered fast enough. It was order tickets and stale quotes. It was people trying to calculate losses with hands that wanted to tremble. It was senior professionals staring at screens in silence. It was young traders realizing that the stories older men told about panics were not exaggerations. It was clients discovering that a market price was not a promise. It was the strange humiliation of modern systems under old-fashioned fear, and for some people it was the moment they understood that Wall Street's confidence had been built on the assumption that there would always be someone on the other side of the trade. The official volume that day was enormous, roughly 604 million shares on the New York Stock Exchange, a record at the time. That detail matters because the market did not fall on no activity. It fell in activity so heavy that the system strained to process it. This was not a deserted market where no one showed up. It was a crowded market where too many people wanted the same thing: sell, hedge, reduce, protect, escape. The words differed depending on the institution, but the direction was similar. The market became a place where private caution produced public collapse. Outside Wall Street, the country absorbed the news unevenly. Some people heard it in offices before the close. Some saw it on the evening news. Some learned it from radio reports while driving home. Some found out when a spouse or friend said, "Have you heard what happened to the market?" The number was so large it required explanation. Anchors had to tell viewers that 508 points was not just a record point decline, but a collapse of nearly a quarter of the Dow. Newspapers prepared front pages with the kind of language editors save for wars, elections, assassinations, and disasters. The words Black Monday attached themselves to the day almost immediately because the country needed a name for what had happened. Names make events easier to hold, even when they do not make them easier to understand. For ordinary Americans, the fear was complicated. Many did not own stocks directly. Many did not know what futures were. Many had never heard the phrase portfolio insurance before and would not have known why it mattered. But they knew enough to be afraid. They knew retirement funds might be involved. They knew companies might be affected. They knew the stock market had been treated for years as a sign of American strength, and now that sign had cracked in public. Some people wondered whether banks were safe. Some wondered whether jobs would be lost. Some wondered whether the economy was about to fall into recession. And almost everyone who remembered family stories of the Great Depression felt that old comparison moved quietly through the room. Could it happen again? This is where hindsight can make us careless. We know now that Black Monday did not become another Great Depression. We know the banking system did not collapse in the same way. We know the Federal Reserve acted to support liquidity. We know markets recovered much of the loss relatively quickly. We know, in other words, that the day was contained. But the people sitting in front of televisions on the evening of October 19th did not know that. They knew the market had just experienced the worst one-day percentage fall in its modern history. They knew the experts on television looked serious. They knew the anchors were comparing the day to 1929. They knew that when Wall Street loses that much paper wealth in a few hours, something invisible but important has been damaged. Confidence had been wounded, and no one could say how deep the wound went. Inside financial firms, the closing bell did not mean the work was over. In some ways, the next phase had just begun. Trades had to be processed. Margin calls had to be calculated. Clients had to be contacted. Risk had to be measured. Managers needed to know whether firms had enough capital, enough credit, enough operational strength to get through the next morning. Clearing systems, credit relationships, and banks suddenly mattered in a way most investors rarely considered. A stock market crash is not only about prices, it is also about promises. Who owes money? Who must deliver securities? Who must provide cash? Who can meet a margin call? Who can borrow overnight? Who trusts whom? These questions live beneath the surface on ordinary days, but after a crash they rise quickly. There were people that night who did not go home at the usual hour. Lights stayed on, phones kept ringing, messengers moved through buildings, executives spoke to banks, regulators spoke to exchanges, firms tried to determine whether clients could meet obligations. People who had spent the day in noise now worked through a quieter kind of fear, the after-hours fear of discovering what the damage means. During the trading day, the crisis is visible and loud. After the close, it becomes accounting, credit, exposure, liquidity, settlement. The vocabulary becomes colder, but the stakes remain human. A missed payment by one firm could affect another. A failure to lend could deepen panic. A refusal to trust could turn a market crash into something closer to a financial system crisis. That was the danger officials understood as night settled over New York. For the people who had been on the trading floor, The end of the day must have felt unreal. The room that had carried hours of shouting began to empty. Paper lay underfoot. Voices were hoarse. Faces looked older than they had that morning. Some people would have gone out for drinks because that is what people do after surviving something they do not yet understand. Some would have gone straight home, too tired to speak. Some would have called spouses and said only that the day was bad, very bad. Some probably watched the news and felt strange seeing the thing they had just lived through turned into a national broadcast. Television can flatten experience. It takes sweat, noise, confusion, and hours of pressure and turns them into a shot of the exchange floor, a chart, a solemn anchor, a number. The number was 508.32. That is the number history remembers. But the people who lived that Monday remembered other things too. The unopened stocks, the futures falling ahead of the cash market, the phones, the failed attempts at reassurance, the temporary rebounds that did not hold, the last hour when the market seemed to drop through every level people had hoped would matter, the moment when someone said 1929 and no one laughed, the feeling that modern finance had become fast enough to frighten itself, the silence after the close, when the noise stopped and the scale of the loss finally had room to enter. Black Monday was not the end of American capitalism. It was not the start of a depression. It did not bring breadlines or bank runs in the way people feared that night. But on October 19th, none of that was guaranteed. What the day revealed was simpler and more frightening. The market that had risen for years could fall faster than almost anyone had imagined. The tools built to manage risk could transmit it. The confidence of a long boom could vanish in a single session. And when the numbers started dropping, all the language Wall Street had built around discipline, strategy, hedging and sophistication could not hide the older truth beneath the machinery. A market is still made of people trying to decide what everyone else will do next. And on that Monday, too many people decided that everyone else was going to sell. Night came to New York with the exchange closed, but the question still open. In offices, people checked positions. In homes, families watched the news. In Washington, officials weighed what kind of reassurance might be needed before morning. Overseas markets waited for their turn to respond. The crash had happened, but the danger had not passed simply because the clock had reached 4. A one-day fall can become a historical event. The day after determines whether it becomes something worse. And as Wall Street moved into the dark hours after Black Monday, no one could honestly say what Tuesday would bring. There are places where panic looks the way you expect it to look. A crowd running from smoke, a ship's deck tilting under black water, a city street after a loud sound that no one can identify. Bodies move first and explanations come later. But on the floor of the New York Stock Exchange on October 19th, 1987, panic wore work clothes. It wore trading jackets, it carried order tickets, it shouted prices, it answered phones, it checked screens, it tried, with real effort, to keep doing a job while the job itself was changing shape under its feet. That is what made the trading floor so strange that day. It was not a room where everyone simply lost control at once. It was a room where thousands of people were trying to preserve control inside a system that had begun to move faster than control could follow. To understand the floor that day, you have to set aside the clean image of the market that most of us carry around now. Today, when people think about stocks, they often imagine a quiet screen, a chart, a phone app, a number changing in red or green. It feels almost weightless. You tap, you refresh, you watch. In 1987, the market still had a body. It had elbows, voices, paper, sweat, crowds, and shoes planted hard on a floor that had absorbed generations of American financial noise. The New York Stock Exchange was not just a symbol on television. It was a working machine made partly of humans. At the centre of that machine were specialists, the people assigned to specific stocks, responsible for helping maintain what the exchange called fair and orderly markets. That phrase sounds calm. Fair and orderly. It sounds almost ceremonial. But on Black Monday, fairness and order had to be attempted in the middle of sell orders, arriving like water through a broken ceiling. The specialist's job was not glamorous in the way the public often imagined Wall Street glamour. He stood at a trading post with a book of orders and a responsibility that could become heavy very quickly. For each stock assigned to him, he had to help bring buyers and sellers together. If buy and sell orders did not naturally match, he could use his own firm's capital to buy or sell, stepping into the market to smooth trading. In ordinary conditions, this was one of the mechanisms that made the exchange function. If the imbalance was manageable, the specialist could absorb some pressure. If buyers were scarce, he might buy. If sellers were scarce, he might sell. He did not eliminate risk, but he helped the stock trade in a way that did not become wildly disorderly at every bump in the road. But what happens when the imbalance is not manageable? What happens when the sell side is not a problem in one stock, but a problem in hundreds? What happens when the pressure is so large that opening a stock at the previous day's range would be absurd, but opening it much lower might frighten the entire market even more? That was the question facing specialists that morning. Their responsibility did not disappear because conditions were extraordinary. In fact, the extraordinary conditions made their responsibility more visible. They could delay openings. They could halt trading in certain stocks when order imbalances made a fair opening difficult. They could try to publish indications, ranges at which the stock might open, giving the crowd a sense of where supply and demand might meet. But every delay carried its own danger. A stock that did not open left investors without a real current price. A delayed opening in a famous name did not soothe the floor. It whispered that the pressure inside the stock was too great to show yet. Imagine a specialist standing there with a crowd pressing around his post. The paper in front of him does not look like normal paper anymore. It looks like accusation. Sell order after sell order. Clients wanting out. Institutions reducing exposure. Brokers asking where the stock will open. The specialist sees buyers, but not enough of them, and not at prices anyone wants to say aloud too quickly. He knows that if he opens too high, the selling may crush the stock instantly. If he opens too low, he may help set off another wave of fear. If he delays, he may be accused of hiding the truth. If he trades, he risks his own capital. If he does not, he risks the accusation that he failed to make a market. There is no comfortable choice, only choices that will be judged later by people sitting in quieter rooms. That is one of the hard truths about crisis. The people making the first decisions often do so with incomplete information, while the people evaluating those decisions later have reports, charts, timelines, and the luxury of knowing what happened next. On October 19th, the people on the floor did not have that luxury. They did not know whether the decline would slow in an hour. They did not know whether officials would step in. They did not know whether buyers were waiting just below the market, or whether the buyers had stepped away entirely. They knew the phones were ringing. They knew the futures market was already deeply lower. They knew the order imbalances were real. They knew the room was no longer moving with its normal rhythm. There was a physical sound to that loss of rhythm. A trading floor always had sound. But people who worked there could tell the difference between noise and alarm. Noise is a language when you understand it. Panic is what happens when the language begins to fail. Numbers were shouted, but the numbers changed too quickly. A quote given one moment might be useless a moment later. A clerk carrying an order might discover that the market he was aiming for no longer existed. A broker trying to report back to a client might have to explain that the execution was delayed, or that the stock had not opened, or that the price had moved far below what had been expected. The human voice, which had always been one of the floor's main instruments, could not keep up with the speed of fear moving through the system. And the phones. It is almost impossible to understand Black Monday without hearing the phones. Phones on desks, phones against ears, phones ringing in branch offices, phones ringing in brokerage houses from coast to coast, phones being answered by people who had already answered the same frightened question dozens of times and would answer it dozens more. Clients wanted to sell, clients wanted prices, clients wanted explanations. Some clients were angry because anger feels more useful than fear. Some were quiet in a way that was worse. A broker could hear a client breathing on the other end and know that the person was watching years of savings turn into a number he did not understand. There were professionals speaking to professionals, and there were ordinary investors speaking to brokers who suddenly sounded less certain than they had sounded during the boom. On the exchange floor, the flow of orders became overwhelming. Automated systems that had seemed like helpful modern tools now had to carry a volume of activity far beyond ordinary expectations. Orders were routed electronically toward trading posts, but electronic routing did not mean electronic magic. Somewhere on the floor, human beings still had to deal with the pressure those orders represented. Systems that had worked well in calmer markets began to back up, delay, strain. Confirmation slowed. Information did not always return cleanly. A person waiting to know whether an order had been filled could wait too long, and in a crash too long can mean a very different price. The problem was not only that people wanted to sell, it was that the machinery for processing that desire was becoming part of the anxiety. There is a kind of helplessness that comes from not knowing whether your action has happened. Think about mailing an important letter and never knowing whether it arrived. Now compress that feeling into minutes, attach it to large sums of money, place it inside a falling market, and surround it with people shouting. That was part of the experience for many market participants. An order had been sent. Had it arrived? Had it been executed? At what price? Was the confirmation delayed because of a system backlog or because the order had not gone through? Should another order be sent? Would sending another create a duplicate? Every uncertainty bred another decision, and every decision had to be made while prices continued moving. This is why confusion and fear are so closely related in markets. Fear can sometimes be managed if information is clear. You may not like what is happening, but at least you know what it is. Confusion removes even that. On Black Monday, delays in openings and trading halts in individual stocks made it difficult for futures and options traders to know the true value of the underlying market. Futures traders looked at the stock market and saw stale prices in stocks that had not opened. Stock traders looked at futures and saw panic that seemed to be racing ahead of the cash market. Options traders tried to price contracts when the underlying stocks were uncertain or delayed. Each market needed information from the others, and each market was partly blinded by stress in the others. They were connected enough to transmit fear, but not coordinated enough to calm one another. On the floor, this interconnection did not feel like an elegant financial system. It felt like being pulled from several directions. A trader might hear that futures were sharply lower. He might see that the stock he needed was delayed. He might know that program trades were hitting the market. He might suspect portfolio insurers were selling. He might hear that options markets were strained. He might hear rumours from overseas. He might hear a client screaming through a phone. Each piece of information was real or plausible, but there were too many pieces and not enough stable ground to arrange them. So the trader did what people do under pressure. He simplified. He looked at the direction. The direction was down. Down is a powerful word on a trading floor. It is not merely a description. It becomes instruction. If prices are down, clients ask why. If prices are down hard, clients ask whether to sell. If prices are down faster than expected, models may call for hedging. If futures are down, cash traders expect pressure. If stocks are down, futures traders expect pressure. If everyone sees down, everyone begins to prepare for more down, and the preparation itself can become part of the movement. That is the way panic entered the floor. Not as one enormous scream, but as 1,000 small recognitions that the same direction had taken hold of everyone's attention. And yet people kept trying. That is worth saying plainly. It is easy to describe the day as if the market simply collapsed while people watched. But the floor was full of effort. Specialists tried to open stocks. Clerks tried to route orders. Traders tried to find bids. Brokers tried to get clients' answers. Exchange officials tried to monitor conditions. Some people bought. Some firms stepped in. Some corporate buybacks helped ease pressure in particular places. Not everyone vanished. Not everyone ran. The market did continue to function in the broad sense that trading happened, prices were made, and the exchange did not simply close its doors in the middle of the worst of the panic. But functioning is not the same thing as functioning smoothly. A person can walk with a broken rib. A market can trade while every breath hurts. The most frightening moments came when market makers seemed to step back. This happened in different ways across different markets. In the over-the-counter market, some market makers were reportedly swamped with calls, and in some cases they did not answer or could not answer. In futures pits, some participants withdrew from the market as losses and uncertainty grew. This is not difficult to understand if you picture the individual human being behind the role. A market maker is expected to provide liquidity, to stand ready to buy or sell. But standing ready is costly when prices are moving violently. If you buy in order to make a market and the price falls immediately, you may be damaged badly. If you keep buying while everyone else sells, you may not be brave. You may be ruined. The public often wants market makers to be shock absorbers in a crisis, but shock absorbers can break if the force is too great. That possibility that the people expected to provide liquidity might not have enough capital, confidence or willingness to do so added another layer of fear. A market needs more than desire to trade. It needs intermediaries who believe they can survive the act of intermediating. If those people step back, prices can jump rather than move. Bids can disappear, spreads can widen. A trader asking for a market may get an answer that feels less like a price and more like a warning. On Black Monday, the fear that market-making capacity was stretched became part of the emotional atmosphere. Even people who did not understand every structural detail could feel the effect. The floor no longer had the depth it was supposed to have. There is something almost cruel about the word liquidity because it sounds so gentle. It suggests water, flow, ease. In a normal market, liquidity is the comfort of knowing you can sell without destroying the price. In a panic, liquidity becomes visible by disappearing. The absence is sudden and frightening. A stock that seemed easy to trade last week becomes difficult. A size that would have been absorbed easily on Thursday becomes dangerous on Monday. A quote that looked firm turns out to be small. A buyer who seemed interested lowers his bid or steps away. This is when people discover that liquidity is not a permanent feature of an asset. It is a mood shared by buyers and sellers, and moods can change. By the afternoon, the strain had become bodily. Men who prided themselves on toughness looked exhausted. Voices grew hoarse. People who had been standing for hours felt the ache in their legs only when they stopped moving for a few seconds, and there were few chances to stop. The air on the floor must have felt heavy with noise and heat, the way crowded rooms do when everyone is breathing too hard. Trading jackets were no longer costumes of confidence. They were work clothes in a storm. Someone wiped his forehead. Someone snapped at a colleague and forgot it instantly because there was no time to hold a grudge. Someone made a mistake and felt it like a punch. Someone tried to correct a mistake and found the price had moved again. Someone looked toward the clock and realized there was still too much time left. The clock mattered. A trading day has a beginning and an end, and that end can become its own force. As the close approached, decisions that might have been postponed became urgent. Institutions did not want to carry unwanted exposure overnight. Portfolio insurance strategies could call for additional hedging as the market dropped. Brokers facing frightened clients needed to act before the bell. Traders who had waited for a bounce had to decide whether waiting had been a mistake. Buyers who might have stepped in earlier asked whether it was safer to wait until Tuesday. The final stretch of the day became a narrowing corridor. There was less time, more fear, and no clear bottom. This was when the numbers seemed to stop behaving like numbers and start behaving like blows. Down 200, down 300, down 400. The Dow dropping by hundreds of points in 1987 was not like hearing those numbers today. The market was smaller then. The scale was different. Every additional 100 points carried a weight that could be felt across the room. At some point, the old comparisons became unavoidable. People thought of 1929. Some said it. Others did not need to. The comparison was already present. It lived in the fear that this might not be only a stock market event. It might be the first day of something larger, something with unemployment lines, bank trouble, failed firms, and years of regret. The people on the floor were not historians in that moment, but American financial memory was standing behind them. The final 90 minutes were especially severe. Selling intensified. The market's decline deepened sharply. In a classroom, this can be described with a chart. On the floor, it was a lived acceleration. A bad day became a disastrous one while people were still inside it. That is a difficult experience to process because the mind keeps trying to catch up with the previous level, while the current level is already worse. You think, this is the worst I have seen, and then the market moves lower. You think, surely buyers come in here, and then they do not come in with enough size. You think, the close is near, and then you realise that near is not near enough. The last part of the day did not feel like numbers being marked down on a sheet. It felt like the floor dropping in stages beneath everyone's feet. When the closing bell finally sounded, there must have been a strange mixture of relief and disbelief. Relief because trading had stopped. Disbelief because stopping trading did not undo anything. The Dow had fallen 508.32 points. The one-day percentage loss was 22.6%. That number moved through the room with the force of a diagnosis. For hours, people had been living inside motion. Now the motion became a fact. The day had a final print. The loss could be written down, and because it could be written down, it could be compared. It was worse in percentage terms than the worst day of 1929. That did not mean another Great Depression had begun, but no one could know that for certain at 4 p.m. on October 19th. The closing bell ended the trading session. It did not end the fear. After the close, the floor changed. This is something people rarely imagine. The noise that had filled the room for hours began to thin. A trading floor after a violent day can feel almost eerie. Papers remain. People remain. But the active shouting gives way to smaller conversations, stunned laughter, curses, silence. Some people do the math again because the first answer feels impossible. Some call desks upstairs, some wait for instructions, some stand for a moment doing nothing because their bodies have been moving all day and suddenly do not know what to do with stillness. Television cameras capture part of this, but cameras cannot capture the private realization in a person's mind when he understands that he has just lived through a day people will ask him about for the rest of his career. The work continued because the market is not finished when the bell rings. Executions had to be confirmed, breaks had to be resolved, clients had to be told what had happened to their orders, firms had to understand exposures. Margin calls had to be prepared, clearing relationships had to be checked. The crash had moved from the floor into the back offices, into operations departments, into bank lines, into accounting systems, into the quiet rooms where people ask whether promises can be honoured. The public remembers the shouting floor, but the after-hours machinery mattered just as much. A market can survive a price collapse if the system of settlement and credit holds. If that system fails, a bad day can become something worse. So the people on the floor left slowly or stayed late, carrying the day with them. Some walked into the evening air of Lower Manhattan and found the city still there, which must have felt strange. Restaurants open, traffic moving, lights in windows, people outside the financial world living ordinary Monday nights. The contrast would have been sharp. Inside the exchange, a historic loss. Outside, a city that did not yet fully know what the number meant. A trader could pass someone laughing on the sidewalk and feel as if they lived in different countries. He had spent the day inside a machine that seemed to come close to breaking. The person beside him was only trying to get home, and that is the part of Black Monday that stays with me. Not only the size of the decline, Not only the structural flaws, not only the computers and futures and portfolio insurance, but the human experience of being trapped inside a system at the moment it reveals its limits. The people on the trading floor were not watching history from a safe distance. They were being used by it, tested by it, carried along by it. Their training, confidence, habits, tools, voices and rituals were all placed under pressure. Some held, some failed, most simply strained. And in that strain you can see something larger than Wall Street. You can see how modern systems depend on people believing that other people will keep doing their part. Buyers will buy. Market makers will quote. Systems will route orders. Phones will connect. Prices will mean something. The floor will open. The bell will close. The promises will settle. On October 19th, those beliefs did not vanish completely, but they shook hard enough that everyone felt it. The market had not lost everything in the literal sense. Companies still existed. Factories still stood. Workers still woke up the next morning. The United States did not fall into depression because of that one day. But inside the trading floor as panic took over, it felt possible for a few hours that something much larger had been exposed. The financial world had become faster, more connected, more sophisticated, and more fragile than its own confidence had allowed it to admit. And now, with the floor quieting after the worst one-day fall the Dow had ever seen, the fear moved outward from the exchange into offices, homes, newspapers, television studios, banks, and government rooms, where people had to face the question that always comes after a crash. Not what happened today, but what happens tomorrow. The strange thing about a financial crash is that the loudest part can end before the fear does. At 4 o'clock in the afternoon on October 19th, 1987, the closing bell rang at the New York Stock Exchange, and in the most literal sense, the market stopped. The shouting on the floor began to thin. The last official prices were fixed. The Dow Jones Industrial Average had fallen 508.32 points, 22.6% in a single day, a number so large that it did not fit comfortably inside the habits of professional speech. But outside the exchange, the country was just beginning to understand what had happened. The crash had ended for the trading day, but for millions of people the panic was only arriving now, carried by television anchors, radio bulletins, evening newspapers, phone calls, and the terrible old comparison that Americans had been trained to fear since childhood. Was this another 1929? That is the question that hung over the night. Not because every American owned stock. Many did not. Not because every family understood index futures, portfolio insurance, program trading, margin calls, clearing houses, or the fragile plumbing of modern finance. Most did not. But almost every adult in America understood the Great Depression as a kind of national warning story. It was not distant history in 1987 the way it feels now. There were still parents and grandparents alive who remembered breadlines, bank failures, men leaving home to look for work, children sensing that adults were frightened even when no one said the word hunger out loud. The Depression lived in family stories, in habits of thrift, in old fears around savings accounts, in the way older people distrusted easy prosperity because they had once seen prosperity vanish. So when the evening news said the stock market had suffered a one-day percentage fall even worse than the worst day of 1929, the number did not land as information only. It landed as memory. Picture an ordinary living room that evening. Not a mansion, not a Wall Street apartment with a view of the East River, just a regular house somewhere in Ohio or California or Pennsylvania or Texas. The television is on. Maybe dinner is still on the table. Maybe someone has come home from work and loosened a tie. Maybe children are doing homework nearby, only half listening until they hear the serious tone in the anchor's voice. The screen shows the floor of the New York Stock Exchange, crowded and chaotic, men in jackets, paper on the floor, faces that look strained under the lights. Then the number appears, down 508 points, down nearly 23%. The adults in the room may not know exactly what that means for them tomorrow, but they know enough to grow quiet. Because the stock market is one of those things people can ignore while it rises, but when it falls that hard, it seems to reach into every room in the country and ask a question no one is ready to answer. What did it mean for retirement accounts? What did it mean for pension funds? What did it mean for banks? What did it mean for jobs? What did it mean for the mortgage, the factory, the family business, the college fund, the insurance company, the local employer whose stock had just collapsed with everything else? The fear was not always precise. That is part of what made it powerful. A precise fear can sometimes be managed. You can take a number, make a plan, call a person, change a payment, delay a purchase. But vague fear spreads into every corner of life. It turns a market crash into a question about the future itself. People did not know whether they were watching a temporary break or the first sentence of a much longer disaster. In Washington, the language of reassurance began almost immediately, but reassurance is difficult when the event is still smoking. President Ronald Reagan was asked about the stock market that day, and his public response tried to separate Wall Street's collapse from the broader economy. He said there was nothing wrong with the economy, even as reporters pressed him with questions about panic and another great crash. That kind of statement is both necessary and difficult. Leaders cannot stand before microphones and say they are terrified. They cannot allow their own uncertainty to become fuel for the next morning's selling. But they also cannot make people forget what they just saw. The public had watched a record collapse in the market, and no presidential sentence, however calmly delivered, could immediately restore the feeling that the system was stable. This is one of the burdens of leadership during a financial crisis. If officials sound too calm, people wonder what they are hiding. If they sound too alarmed, they may make the crisis worse. Every word becomes part of the market. Every pause matters. Every phrase can be read by traders, bankers, foreign governments, journalists, and ordinary citizens looking for clues. On the night of October 19th, the United States government had to communicate confidence before it could fully know whether confidence would hold. That is an uncomfortable position, but it is one governments face again and again during moments of financial fear. They must help create the stability they are also trying to describe. Inside the Federal Reserve, the pressure was even more direct. Alan Greenspan had been chairman for only a short time. He had taken office in August, barely 2 months before the crash, and now he was facing the kind of test that can define a career before a person has fully settled into the chair. The Fed's public statement would come the next morning, when it would announce its readiness to serve as a source of liquidity to support the economic and financial system. But on Monday night, the work behind that statement was already urgent. The issue was not simply that stock prices had fallen. Falling prices by themselves are painful, but not always catastrophic. The deeper danger was that the crash might create a credit crisis, that firms might fail to meet obligations, that banks might pull back from lending to securities firms, that the machinery of settlement and payment might jam at the exact moment it needed to keep moving. That machinery is not the part of Wall Street most people see. It does not have the drama of the trading floor. It does not make good television. It happens in back offices, clearing systems, bank credit departments, operations rooms, and conversations between institutions whose names rarely appear in ordinary conversation. But after the closing bell on Black Monday, this hidden machinery mattered as much as the prices on the screen. Trades had been made, money had to move, securities had to be delivered, margin calls had to be met, firms that had traded for clients needed to know whether those clients could pay. Clearing members needed credit. Banks had to decide whether to keep lending into a frightening situation. Trust, which sounds soft and emotional, became a practical requirement. If banks stopped trusting securities firms, if firms stopped trusting counterparties, if everyone tried to protect themselves by withholding credit, then the crash could become something much more dangerous than a one-day market break. This is where the night becomes tense in a different way. During the trading day, panic had been visible. It had shouted. It had run through the futures markets and the stock exchange. It had pushed prices lower in front of everyone. After the close, the panic moved into rooms where people spoke more quietly. It became phone calls between senior executives and bankers. It became questions about liquidity lines. It became lists of exposures. It became calculations of how much cash would be needed before morning. A man who had spent the afternoon watching the Dow fall now sat at a desk with a legal pad, trying to understand whether his firm could meet tomorrow's demands. Someone at a bank had to decide whether extending credit was prudent or dangerous. Someone at a clearinghouse had to watch obligations gather and hope the system would not choke on them. The words were technical, but the fear beneath them was simple. Would the promises hold? For people inside financial firms, that Monday night did not feel like the end of work. It felt like the beginning of the second shift of disaster. The trading floor had been exhausting, but at least it had been immediate. You knew what was happening because the number was falling in front of you. After hours, the danger became less visible, and in some ways more frightening. It hid in unsettled trades, in client accounts, in credit lines, in margin requirements, in the question of who would be able to pay whom by the next morning. People stayed late. Lights burned in office windows. Secretaries, clerks, operation staff, traders, managers and executives all became part of the same anxious machine. Some were calling clients, some were correcting records, some were waiting for numbers to come back from another department. Some were too tired to be frightened in a fresh way and simply kept moving because the work had to be done. It is worth pausing over those people because history often gives us the names of chairmen, presidents and famous financiers, but crises are carried by many unnamed workers. Someone had to answer the phone when a client called, voice shaking, to ask what had happened to an order. Someone had to type confirmations. Someone had to check whether trades matched. Someone had to carry paper from one floor to another. Someone had to stay in an office late enough that dinner became a vending machine or a cold sandwich eaten without noticing the taste. These people were not deciding national policy. They were not appearing on the evening news, but the financial system depends on ordinary competence under extraordinary pressure. On that night, thousands of people were doing work that would never be remembered by name but mattered, because the system could not afford additional confusion. And then there were the families of those workers. A spouse waiting at home, watching the news and wondering when the phone would ring. A child asking why everyone on television looked upset. A husband or wife trying to understand whether the person they loved was in danger of losing a job, a bonus, a career, or simply sleep. The financial world often pretends it is separate from domestic life, but it never is. A market crash travels home in the face of the person who walks through the door. It sits down at the dinner table, even if no one wants it there. It changes the tone of an evening. A trader who had spent the day shouting might come home and say very little. A broker might keep calling clients from the kitchen phone. A manager might sit on the edge of the bed, still dressed, watching the late news repeat the same footage from the exchange floor. The market was closed, but in those homes, it had not stopped moving. Across the country, newspapers prepared their front pages. Editors understood they were handling a historical event, but they also had to decide how frightening their language should be. Crash was the obvious word, and it was the accurate word, but it carried the weight of 1929. Plunge, panic, collapse, record loss, Wall Street rout, all of these words moved through newsrooms as headlines were built. Photographs of the exchange floor gave the story a face. Without photographs, a market loss can seem too abstract. With them, the public saw men with hands pressed to their faces, traders shouting, people leaning over posts as if the room itself were tilted. The images made the invisible visible. They told viewers and readers that this was not just a statistic. People had been inside it. Television did something even more powerful. It repeated the day. In living rooms across America, the same scenes played again and again. The closing number, the percentage loss, the comparison to 1929. Interviews with brokers, analysts, economists and officials. The camera loved the trading floor because it looked like panic had a location. But the real panic had already moved outward. It was in the questions people asked after the broadcast ended. Should we call our broker tomorrow? Should we sell before things get worse? Should we stop contributing to the retirement account? Should we postpone buying a house? Should we worry about layoffs? Should we move money out of the bank? Should we do nothing? Doing nothing can be very hard when everyone is telling you that something historic has happened. This is one of the quiet dangers after a crash. The first day is about what happened. The second day is about what people decide to do because of what happened. If enough ordinary investors call to redeem mutual fund shares, funds may need cash. If enough institutions reduce exposure, markets may face more selling. If enough banks become cautious, securities firms may struggle for credit. If enough companies fear tighter conditions, they may delay investment. A crash can become economically damaging not only because of the wealth lost on paper, but because of the decisions people make afterward to protect themselves. Fear changes behaviour, and behaviour changes the economy. That is why the night mattered so much. The country was not merely observing a market event. It was deciding how afraid to be. Older Americans had a special relationship with that fear. Those who had lived through the Depression or grown up in households shaped by it knew the sound of adults trying not to frighten children. They knew the habit of saving string, foil, jars, pennies, old coats, anything that might be useful because once, long ago, useful things had been hard to replace. Some of them watched the news that night with skepticism toward official reassurance. They had heard confident words before in their lives. They knew that experts could be wrong. They knew that a market crash could be dismissed at first and then become something larger. For them, 1929 was not a documentary image of men in hats outside the exchange. It was a family wound. The question of another depression did not sound dramatic to them. It sounded like something history had already proved it could do. Younger Americans experienced the fear differently. Many had grown up in the post-war world, in an economy that, despite recessions and inflation and hardship, had generally taught them to expect growth. The 1980s had given them a culture of success, ambition, and rising markets. For some, Black Monday was their first real encounter with the idea that modern financial systems could break in old-fashioned ways. They had computers, satellites, futures contracts, business schools, central banks, economists, analysts, and global coordination. And still, the market had fallen harder in one day than it had on the worst day of 1929. That contrast was unsettling. The modern world had not abolished panic. It had only given panic better tools. There were people that night who tried to make the rational case. They pointed out that the real economy was still functioning. Factories had not vanished because stock prices fell. Stores still had customers. Banks were not immediately failing across the country. Employment had not collapsed between breakfast and dinner. Corporate earnings did not disappear in one session. America had not physically become poorer in the way a burned harvest makes a farming town poorer. A crash in market value is not the same thing as every business losing its ability to operate. These were important points. They were also emotionally insufficient. Because the stock market is partly a claim on future belief, and belief had just suffered a public injury. People did not need factories to vanish that night to worry that they might slow later. They did not need banks to fail that night to wonder whether they were exposed. They did not need layoffs that night to fear the decisions executives might make in the weeks ahead. The comparison to 1929 was imperfect, but unavoidable. In 1929, the crash had come at the edge of a much deeper economic breakdown, and the banking system's later failures helped turn financial panic into years of depression. In 1987, the banking system was stronger. Deposit insurance existed, monetary authorities had different tools and different memories, and policymakers had studied the mistakes of the early 1930s. But those distinctions are easier to say with hindsight than they were to feel that night. The public did not live inside a policy paper. It lived inside television light, newspaper ink, and personal memory. When the worst market drop in percentage terms in modern Dow history was compared to 1929, people heard the comparison before they heard the qualifications. Somewhere that night, a retired couple may have taken out their most recent brokerage statement and placed it on the table. The numbers on the paper were already out of date, but they were the only numbers they had. They tried to guess what had been lost. Maybe they owned blue-chip stocks bought slowly over decades. Maybe they owned shares in a mutual fund recommended by a friend. Maybe they had enough savings to feel almost secure before the crash, and suddenly not enough courage to feel secure anymore. They might not sell the next day, they might do nothing, but the feeling had changed. That is important. Wealth is not only arithmetic, it is also trust in the future. That night the arithmetic was uncertain, but the trust had clearly been damaged. Somewhere else, a worker with no stock portfolio at all may have watched the same broadcast and wondered about his job. This is the way Wall Street reaches people who never chose to participate. If markets fall hard enough, companies may cut spending. If credit tightens, employers may delay expansion. If consumers become afraid, sales may weaken. If sales weaken, hours may be reduced. The chain may be long, but ordinary people know that long chains can still pull on them. A factory worker did not need to understand stock index futures to know that rich men losing money in New York could eventually become bad news in his town. That knowledge may have been vague, but it was not irrational. In New York, the emotional geography of the night was divided. In some bars and restaurants near Wall Street, people gathered because being alone after a day like that was difficult. They told stories from the floor. They compared losses. They laughed too loudly at things that were not funny. They blamed computers, Washington, Germany, the dollar, program traders, portfolio insurers, the press, the Fed, the exchange, anyone available. Blame gave the night structure. It allowed people to turn helplessness into argument. In other rooms, the atmosphere was quieter. Senior people spoke in low voices about credit. Younger people wondered whether they still had careers. People who had made money for years learned that one day could rearrange reputation. No one knew yet who had been merely hurt and who had been broken. The international dimension made the night even more uneasy. Because while Americans slept, other markets would open. The crash had already been global, moving through Asia, Europe, and the United States, but the sequence was not finished. Traders knew that Tuesday morning in New York would be shaped partly by what happened overnight elsewhere. This is one of the things that made 1987 feel new. Financial fear did not respect the American closing bell. It kept travelling. The sun would rise on markets in other parts of the world, and their reactions would come back to New York like weather reports from the future. A person could go to bed in America not knowing whether Tokyo, Hong Kong, London and other markets would steady or deepen the panic. Sleep for anyone close to the market was not easy. And yet some people had to sleep because human bodies cannot live on adrenaline forever. The trader whose voice had gone hoarse eventually sat in a cab or on a train. The broker who had called clients until late eventually turned off a light. The operations clerk who had checked confirmations until the numbers blurred eventually went home. The retiree who watched the late news eventually folded the newspaper or turned off the television. But the mind does not obey the switch. It keeps moving. It returns to the number. 508.32. It returns to the percentage. 22.6. It returns to the phrase worst since, worse than, biggest ever. It returns to the question that makes the ceiling above a bed feel too close. What happens tomorrow? That night, America did not know it was on the edge of recovery rather than collapse. It did not know that Tuesday would bring strong early selling and then a powerful rebound. It did not know that the Federal Reserve's liquidity support would help calm the system. It did not know that the stock market would recover far faster than the nightmare comparison suggested. It did not know that future historians would call Black Monday frightening but contained. A crash, that exposed market structure failures without producing another depression. All of that belonged to later knowledge. On the night of October 19th, the people inside the moment had only uncertainty, and uncertainty is where fear does its best work. The darkness after Black Monday was not like the darkness after a natural disaster, where people can see the fallen trees, the broken windows, the flooded streets. The damage was mostly invisible, written in prices, accounts, obligations, and confidence. But invisible damage can be more frightening because it leaves the imagination too much room. A person could not walk outside and inspect the market the way one inspects a roof after a storm. The market existed in offices, screens, exchanges, banks, and mines. It had fallen through a number, and now everyone had to decide whether the floor beneath that number was still there. So America waited. It waited in financial offices where lights stayed on. It waited in Washington, where officials prepared reassurance and watched credit conditions. It waited in bank departments where lending decisions for the next morning mattered more than usual. It waited in homes where people calculated losses they could not yet confirm. It waited overseas as markets opened into the aftershock. It waited in lower Manhattan, where the exchange floor, so violent with noise during the day, stood quiet at night, ready to fill again with bodies and voices in the morning. The question was not whether Monday had been terrible. That had already been answered. The question was whether Monday had been a single terrible day, or the first door opening into something much longer. Before dawn, the people responsible for the system would have to make sure the system could still breathe. Banks would have to lend. Firms would have to meet obligations. Exchanges would have to open. The Fed would have to speak. Buyers would have to appear somewhere, at some price, with enough courage to matter. And the country, still carrying the memory of 1929 in its bones, would watch to see whether the modern financial world could stop a crash from becoming a depression, or whether the long boom had ended not with a correction, not with a warning, but with the beginning of a much darker American story. By the morning after Black Monday, Wall Street had already begun doing what institutions do after a shock. It started looking for language. Not because language could repair the losses, and not because words could make the previous day smaller, but because a disaster without explanation is almost impossible for a system to live with. People needed a cause. They needed a lesson. They needed someone to blame, something to fix, some mechanism to point toward and say, there, that is where the danger entered. The market had fallen 508.32 points, 22.6%, in a single session, and a number that large could not be allowed to sit there unexplained. It was too frightening. It suggested that modern finance, for all its speed and intelligence and new machinery, could still be seized by the oldest force in markets: fear. The first thing Black Monday changed was the belief that markets could always absorb pressure if they were left alone long enough. That had been one of the quiet assumptions of the bull market. Yes, prices moved. Yes, investors sometimes panicked. Yes, stocks could fall hard. But the system itself was supposed to process those movements. Buyers and sellers would find one another. Specialists would maintain orderly trading. Futures and stocks would remain connected through arbitrage. Institutions would hedge. Technology would make everything faster and more efficient. The machinery might be noisy, but it would work. Then October 19th showed that the machinery could work and still make the crisis worse. Orders were processed, futures traded, programs ran, models gave instructions, people followed procedures, and still the market dropped in a way that made even seasoned professionals wonder whether the structure beneath them was strong enough. That lesson settled into Wall Street slowly because nobody likes to admit that the tools they trusted became part of the problem. It was easier, in the first days after the crash, to blame one villain: program trading, portfolio insurance, computers, foreign markets, Washington, the dollar, interest rates. Greedy investors, cowardly investors, the press. There was plenty of blame to go around, and some of it was deserved. But the harder truth was that Black Monday had not been caused by one bad actor or one wrong decision. It had been caused by a market where many reasonable actions, taken at the same time in the same direction under pressure, produced an unreasonable result. That is a more uncomfortable lesson than simple greed. It means the danger was not only in bad behaviour, it was in the design of the system. After the crash, officials studied the market the way investigators study wreckage after an accident. They looked at the order flow. They looked at futures. They looked at the interaction between Chicago and New York. They looked at portfolio insurance. They looked at liquidity. They looked at the way selling pressure had moved from one market to another and how price declines had triggered more selling. The Presidential Task Force on Market Mechanisms, often called the Brady Commission after its chairman Nicholas Brady, became one of the central efforts to explain what had happened. Its work did not say that one machine had pushed one button and crashed the market. The story was larger than that. It described a system in which stocks, futures, and options were linked financially, but not coordinated well enough under stress. The markets had become one organism in practice, but they were still managed like separate rooms. That changed the way regulators thought about market structure. Before Black Monday, it was still possible for many people to imagine the stock market, the futures market, and the options market as related but separate places. After Black Monday, that idea became much harder to defend. A fall in futures could pressure stocks. Delayed openings in stocks could distort index values. Options markets depended on prices in the underlying shares. Program traders connected one market to another. Institutions moved across all of them. The old boundaries were still there legally and operationally, but fear had shown that it could cross them easily. Once people saw that, they could not unsee it. Wall Street had to start thinking not only about individual markets, but about the whole connected machine. One of the most visible results was the creation of circuit breakers. The phrase itself is useful because it comes from electricity. When a system is overloaded, a circuit breaker stops the current before the wires burn. In markets, the idea was similar. If prices fell too far too quickly, trading could pause. Not forever. Not to pretend losses had not happened. Just long enough to let information catch up with emotion, to give buyers and sellers a moment to reassess, to prevent a blind rush from becoming its own reason for rushing. Before Black Monday, closing a market or halting broad trading carried an uncomfortable smell of weakness. It sounded like something fragile systems did. After Black Monday, a pause began to look less like surrender and more like safety equipment. The circuit breakers that followed did not mean panic had been abolished. No rule can do that. Human beings still fear losses. Institutions still protect themselves. Buyers still step back when prices fall too quickly. But the market now had formal points at which it could stop and breathe. That was a major change. It meant Wall Street had accepted, at least in part, that speed itself could become dangerous. A market does not always become wiser by moving faster. Sometimes it only becomes faster at making the same mistake. The pause was an admission that modern markets needed moments when automatic movement could be interrupted by human judgment. Another change came in the way people thought about liquidity. Before the crash, liquidity was often treated like something that simply existed in major markets, especially in the most important stocks and index products. If you wanted to sell a large position, the assumption was that enough buyers would be there at some price close enough to make the trade manageable. Black Monday damaged that assumption. It showed that liquidity was not a permanent substance sitting inside the market. It was a behaviour. It depended on people being willing to take the other side. And when prices fall too fast, when uncertainty becomes too large, when the risk of catching a falling market feels unbearable, that willingness can disappear. The market may still be open. The screens may still show quotes. The building may still be full of people. But the depth can vanish. That lesson changed risk management. Firms became more aware that a position was not only risky because its price might move. It was risky because it might become hard to exit when everyone else wanted to exit too. A portfolio that looked safe in ordinary conditions could become dangerous in a crisis if the strategy for protecting it required selling into a falling market. A hedge that worked in theory could fail in practice if the market was too strained to absorb the trade. This was not a small lesson. It reached into the way institutions modelled stress. It forced people to ask not only, what happens if the market falls, but what happens if the market falls and everyone tries to hedge at once? That second question is harder, and it is the one Black Monday wrote into Wall Street's memory. Portfolio insurance was one of the great casualties of the crash. It did not disappear from financial thought entirely, because the ideas behind dynamic hedging remained important. But the phrase itself lost much of its comfort. Before October 1987, portfolio insurance had sounded like protection. After October 1987, it sounded to many people like a warning. The strategy had promised institutions a way to stay invested while limiting losses, but the crash showed that when too many investors depended on similar rules, protection could become selling pressure. The private shield could become a public storm. That did not make every model useless. It did make people more cautious about believing that a model could remove the oldest problem in markets, which is that everybody cannot get out at the same price. Computers were not thrown out. That is important. Wall Street did not respond to Black Monday by returning to chalkboards and handshakes. The opposite happened over time. Technology continued to grow. Trading became more electronic, more automated, more complex, and faster than the people of 1987 could have imagined. But the meaning of technology changed. After Black Monday, it became harder to speak about speed as if it were automatically good. Faster execution could reduce costs. Faster information could improve pricing. Faster systems could connect markets more efficiently. But faster fear was still fear. If the human judgment behind the machine was flawed, the machine could deliver that flaw at scale. Black Monday did not stop the technological future of finance. It gave that future a shadow. The Federal Reserve also changed in the public imagination. On the morning after the crash, Alan Greenspan's Fed issued a short but powerful statement saying it stood ready to serve as a source of liquidity to support the economic and financial system. That sentence mattered. It signalled to banks and markets that the central bank understood the danger was not only falling stock prices, but the possibility of a wider credit seizure. Banks needed to keep lending. Securities firms needed access to money. The system needed confidence that cash would be available where it was needed. The Fed's response helped prevent the crash from spreading into a deeper financial breakdown. And because of that, Black Monday became part of the story of the modern central bank as crisis manager. This was not the same as saying the Fed would rescue every investor from every loss. Stockholders still lost money. Firms still had to face the damage. But the crash strengthened the expectation that when market disorder threatened the broader financial system, the central bank would act to provide liquidity. That expectation would matter again in later crises. It would become part of how Wall Street understood the relationship between markets and government. Some people saw it as necessary protection against systemic collapse. Others worried that it encouraged risk-taking by teaching investors that central banks would soften the consequences of disaster. Both arguments would return many times. Black Monday did not settle the debate. It helped create the modern version of it. There is something worth noticing here. The crash did not lead to a new Great Depression, and that fact became almost as important as the crash itself. For one terrible night, America wondered whether the old nightmare had returned, but it had not. The market stabilized. The banking system held. The economy did not collapse into the 1930s. This outcome taught Wall Street two lessons at once, and the two lessons did not sit comfortably together. The first lesson was humility. A market could fall more than 22% in one day. The second lesson was survival. A market could fall more than 22% in one day and the world could keep going. That second lesson was comforting. but it also carried danger. If a catastrophe can be survived, people may eventually begin to treat survival as proof that the next risk can be survived too. Wall Street has always had a complicated memory. It remembers pain sharply at first, then turns it into rules, then turns the rules into background, then builds new risks around the spaces the old rules do not cover. After 1987, traders remembered the day. They remembered where they were, what the floor sounded like, which stocks would not open, how the phones rang, how the last hour felt. For those who lived through it, Black Monday became a reference point. Younger traders would hear stories from older ones the way an earlier generation had heard stories of 1929. But institutions are not people. They do not remember in the same way. People retire, firms merge, technology changes, new products arrive, new generations learn the old lesson as history rather than scar tissue. That is why financial crises repeat in different forms. The details change, but the pressure points remain familiar. One thing Black Monday changed forever was the way Wall Street understood interconnectedness. After 1987, it was no longer realistic to think of a shock as belonging neatly to one exchange, one product, one country, or one group of traders. The crash moved through global markets. It moved through futures and stocks. It moved through institutions and households. It moved from trading floors into television studios, from television studios into living rooms, from living rooms back into brokerage calls the next morning. A modern market event was not isolated. It was a chain reaction. That understanding became central to later thinking about systemic risk, a phrase that would become much more familiar in the decades ahead. Systemic risk means the danger is not only that one person loses money, or one firm fails, but that the connections between firms, markets, and institutions can carry distress outward. That idea seems obvious now because later crises taught it again, especially in 2008. But in 1987, Black Monday gave it a sharp public demonstration. The stock market crash did not bring down the economy, but it showed how quickly trouble could move through connected financial channels. It showed that market structure was not a technical afterthought. It was a matter of national concern. The plumbing mattered, the wiring mattered, the rules for halts mattered, the relationship between exchanges mattered, the willingness of banks to lend mattered, the ability of the Fed to communicate mattered. The people who had once dismissed those details as boring learned that boring details can decide whether a panic remains a panic or becomes a collapse. For ordinary investors, Black Monday changed something quieter. It changed the way many people understood their own exposure to Wall Street. The 1980s had drawn more Americans into the market through mutual funds, retirement accounts, pension funds, and financial products they did not always fully understand. Black Monday reminded them that owning a piece of the market meant owning its fear as well as its growth. A person did not need to be a trader to feel the decline. A person did not need to work in Manhattan to wonder what would happen to savings. The crash helped make the stock market feel both more central and more threatening in ordinary life. It was not just a rich man's scoreboard. It had become part of the machinery of retirement, employment, credit, and national confidence. And yet, after the first fear passed, many investors stayed. That's another part of the story. The market recovered. Over time, the long-term upward movement of American stocks resumed. People who sold in panic locked in losses. People who held on often saw their accounts recover. This became one of the most repeated lessons after the crash, especially for long-term investors. Do not panic. Do not sell at the bottom. Markets can recover from terrifying days. That lesson has truth in it. It has helped many ordinary investors avoid rash decisions, but it can also become too simple if it is used to erase the real danger people faced. On the night of Black Monday, no one knew for certain that recovery would come quickly. Holding steady is easier to praise after the market has recovered than during the hours when it feels as if the floor is gone. So what did Black Monday really change forever? It did not end speculation. It did not end bubbles. It did not end the belief that clever people with clever tools can manage danger better than the people before them. It did not stop Wall Street from building faster systems, larger markets, more complex products, or new forms of leverage. In some ways, it became one more warning that later generations respected and then worked around. But it changed the map. It forced regulators, exchanges, banks, and investors to admit that a modern market could fail in modern ways. The danger was no longer only a crowd outside a brokerage office or a ticker running late. The danger could be hidden in feedback loops, automated strategies, intermarket gaps, liquidity assumptions, and the speed with which institutions copied one another's defensive moves. It also changed the emotional memory of Wall Street. Before Black Monday, 1929 stood almost alone as the great market nightmare. After Black Monday, there was another date people could reach for. October 19th, 1987. A day when the Dow lost nearly a quarter of its value. A day when the market fell faster than the stories people told about safety. A day when technology, confidence, and fear met inside the same machine. It did not replace 1929 because it did not lead to the same economic devastation. But it became its own kind of warning, a reminder that the absence of breadlines does not mean the day was not dangerous, a reminder that a crash can be contained and still reveal something serious. By the end of the week, the immediate terror had eased. Tuesday brought a strong rebound after more early fear. The Fed's reassurance helped. Banks continued lending. Officials worked to prevent the selling from becoming a credit disaster. The market remained volatile, but the worst nightmare did not unfold. Slowly, the language changed from panic to analysis. Reports were written, hearings were held, rules were proposed, systems were adjusted. People who had been frightened began to describe the day with more control than they had felt while living it. That is what people do after a crisis. They turn terror into memory, memory into lesson, lesson into procedure. It is necessary. It is also incomplete. Because somewhere beneath all the reports and rule changes, Black Monday left a simpler truth. Markets are not only machines and they're not only crowds, they are both at once. They are systems built by human beings to process hope, fear, greed, caution, ambition, and uncertainty at scale. The machines can make the process faster. The rules can make it safer. The central bank can provide liquidity. The circuit breakers can pause the fall. But the old human question remains at the centre. What do I think everyone else is going to do? On October 19th, 1987, too many people answered that question the same way. They are going to sell, so they sold first, or tried to, and the market discovered how quickly confidence can become motion. Years later, when another crisis came, people would remember Black Monday in pieces. They would remember the circuit breakers. They would remember the Fed statement. They would remember program trading as a warning about automated pressure. They would remember that a crash does not always become a depression. They would remember, or think they remembered, the lesson about liquidity. But memory in finance is never perfect. Each generation believes its tools are better. Each generation believes it has learned enough from the last disaster to avoid repeating it exactly. And usually it has. The trouble is that history rarely repeats exactly. It changes clothes. It uses new technology. It borrows new language. It enters through the door people forgot to guard because they were still watching the old one. That is why Black Monday still matters. Not because it tells us that every falling market will become a disaster, and not because it proves that technology is bad or that Wall Street never learns. It matters because it shows how confidence is built slowly and lost quickly. It shows how protection can become pressure. It shows how markets that appear deep can become thin. It shows how the systems designed to make finance efficient can also make fear efficient. And it shows that even in a world of models, computers, specialists, regulators, central banks, and global markets, the emotional heart of a crash remains painfully human. When you picture Wall Street after Black Monday, do not picture only the chart. Picture the floor after the bell, the paper underfoot, the stunned faces, the phones still ringing in offices where no one had easy answers. Picture the homes where people watched television and wondered whether the Great Depression had returned. Picture the officials in Washington choosing words carefully because words themselves had become part of the financial system. Picture the bankers deciding whether to keep credit moving. Picture the young trader who had entered the decade believing that speed was power and left that day understanding that speed could also be fear with no time to think. And then picture the market opening again, because that is what it did. Not perfectly, not calmly, not without pain, but it opened. The system breathed. The country did not fall into depression. Wall Street changed its rules, studied its failures, and carried the memory forward, even as it kept building the future that would one day test those memories again. Black Monday did not take everything forever, but for one day, it took the illusion that modern markets were too advanced for old panic. That illusion never fully came back, and perhaps that was the most important thing it changed. The quiet knowledge left behind after the screen stopped flashing and the phones finally went still, that every system built on confidence must also be built for the moment confidence breaks.